go live on YouTube, start recording. So good morning, everybody. It's a pleasure to see you all on this fine day. I myself have moved inside for the first time since I think last March, but I may go outside again depending on how long this meeting lasts. Representative Walker, do you have anything to say?
Thank you. And I just want to say good morning, and it's great to see everybody. And I hope everybody had a wonderful and restful Thanksgiving. It's important because we got a lot of work to do. So good to see everybody.
Representative Scanlon.
Good morning, everybody. And again, as Representative Walker just said, good to see everybody. Hope you did have a good Thanksgiving, and looking forward to hearing some good news from this report today and talking about that going forward. So thank you, Madam Chair.
Thank you. Representative France. Senator Minor. Representative Cheeseman.
Good morning, echoing everyone else's remarks, and I'm ready to rock and roll here.
Who is the Senate Chair of Finance?
Senator Martin, ranking member.
Yeah, thank you. Senator Martin. All righty then. I'm sure that they'll be on in a little bit. As everybody knows, we all have all meetings going on all at the same time. So for those who are listening in, just because someone is not here does not mean that they are not actually listening in. So we have with us today Neil Ayers, the Executive Director of the Office of Fiscal Analysis and the Secretary of the Office of Policy Management. Our usual practice, I think, is to start with OFA. If you want to go ahead and start, Neil. Susan, is he able to share his screen?
Yes, he is.
Neil, go ahead.
Okay. Just get this put up here and minimize folks. Good morning. I'm Neil Ayers with the Office of Fiscal Analysis, and welcome to 2021 Fiscal Accountability Report. Today, we're going to take a look at the general fund budget in the current biennium, fiscal 22 and 23. Unique to this year, we're going to take a look at the impact of the American Rescue Plan Act, or ARPA, as well as the use of some carry forwards. We're going to take a look at the general fund in the out years, fiscals 24, 5, and 6. And finally, we're going to look at the Special Transportation Fund as well as some brief information on bonding. So for the current fiscal year 22, the budget as adopted had a balance of $274.9 million. We recently, with the Office of Policy and Management, adopted updated consensus revenue estimates a couple weeks ago. These increased sales tax by about $155 million. We'll look more at that more in just a minute. There was a $380 million adjustment to federal grants. This had three main components. There was 10% enhanced match under ARPA for home and community-based services. That is about $140 million. There were some technical finalizations for the March and June claiming quarters, basically cleaning up bookkeeping between us and the feds. That netted us about $110 million. And there was a reinstatement of our claim for disproportionate share hospital payments for the John Denver Hospital at UConn, which netted us about $45 million. In total, we upped the estimated revenue for the current fiscal year by that $527.7 million. On the expenditure side, we identified about $141 million in lapses, as well as about $28 million in deficiencies, which we'll detail those in a minute. So all told, we're currently projecting a surplus of about $915.6 million for the current fiscal year. Sales tax. Usually sales tax is a pretty vanilla, steady, about 2% most years growth revenue stream. As you can see, it's gotten a little interesting. Fiscal 19 actually finished pretty well at 4.1%. Fiscal 20, as you would expect, as the pandemic hit, shrank 1.5%. However, fiscal 21, I think an unprecedented growth of 10%. And this is largely due to federal stimulus checks people had available, and people have more disposable income. There was strong consumer spending on taxable goods. And later in this period, there was a return to industries such as restaurants that were strongly impacted by the pandemic. In our current fiscal year, 22, we're still seeing fairly strong growth. We're projecting at about 5% for the year before in the out years tailing off more to the historic norm. On the expenditure side, up top of the line is our projected lapses. Most of this, about 66%, is Medicaid and Husky B. Most of this is related to the federal government extending period of emergency through the end of March, which means that we get an increased federal share of our Medicaid expenditures, which means we don't have to spend as much. This, coupled with some declining utilizations in Medicaid and Husky B, has us lapsing about $94 million in those two agencies, or those two programs. Personal services, we're lapsing about 25 million across all the agencies. The largest of these, about 9 million in Department of Mental Health and Addiction Services, about 8 million in Department of Children and Families, about 5 million in our own legislative management, and about $2.5 million in judicial. We've seen lower caseloads, resulting in lapsing about $10.5 million. About 6.5 of this is in DSS programs and about 3.5 in DCF programs. Finally, we're projecting a lapse of about $8 million in the Teachers Retirement Board Retiree Health Services. This is largely due to moving to a fully insured Medicare Advantage prescription drug plan. And down below the line of deficiencies, almost all of this is adjudicated claims. We're projecting about a $25 million deficiency here. It's a large deficiency, largely because there was no adopted adjudicated claims. We've seen claims of about $14 million through October 1. Looking to the second year of the biennium, there's not as much to adjust here. As with fiscal 22, it started a balance as adopted of $275.4 million. We increased the estimates in sales tax by $144 million in consensus revenue. Federal grants increased by about 110. This shows you a lot of the fiscal 22 adjustments in federal grants were one-time in nature. So the overall adjustment in revenue is about $256 million. Some minor adjustments on the expenditure side results with an estimated $512 million surplus in fiscal 23. So what's this mean for our budget reserve fund? Budget reserve fund, as you know, is capped at 15% of appropriations. To start that this year, that was $3,112 million, and that is the amount that was in the rainy day fund. If you remember the volatility law, that basically says that any amounts received over a certain threshold under the estimates and finals portion of the income tax, as well as the pass-through entities tax, cannot be used for budget balancing purposes and is deposited into the rainy day fund. That threshold started out in 2018 at 3.15 billion. By the end of fiscal 26, it's indexed, it'll be up to about 4 billion. So anyhow, we're estimating about $969 million will be over that threshold, so we'll be going to the rainy day fund. Couple this with the $915 million surplus we just discussed on the previous two slides. We're expecting at the end of this year a volatility deposit of almost $1.9 billion. Now, the cap in the rainy day fund, by the end of the year, we're expecting it to be about $3.2 billion. Therefore, there'll be excess funds in the rainy day fund of $1.766 billion. Under the laws that were adopted back in 2017, any excess from the rainy day fund goes into either the state employees retirement fund or the teachers retirement fund. Go through the same exercise in 23. We're expecting a volatility deposit of 780 million, coupled with the surplus we just discussed of 500 million. Will result at the end of the day of another $1 billion being deposited either into the CSRS or TERS as determined by the treasurer. So over the course of this biennium, we're expecting about $2.8 billion to be deposited into the rainy day fund, or excuse me, into the retirement funds. And this is on top of the $1.6 billion that was deposited at the end of fiscal 21. I've been doing this for a few years now. And like I say, it's a long way from 2017 when we were looking at $2.5 billion deficiencies as far as we could see. We had $200 million in the rainy day fund. Okay. The federal government passed the American Rescue Plan Act, which provided a whole slew of dollars for states, for municipalities, for a lot of different projects. The legislature last year allocated about $695 million in 22 and about $173 million in 23 for a variety of areas of focus. The largest deposit was $170 million that went to support unemployment insurance. This includes about $155 million to either reduce the taxes or interest payments necessary to repay the federal government that was drawn down from during the pandemic. Other than that, I'll just give us a few of the highlights of the largest areas. We had about $110 million were allocated for private providers under the Department of Social Services and Mental Health and Addiction Services. Higher ed had a large portion of this, about $73 million in general support for UConn Health, about $25 million in general support for UConn itself. There's additional $40 million for the Roberta Willis scholarships, and about $34 million for student retention and general support at the Connecticut State Colleges and University Systems. Other allocations from this included about $70 million for workforce initiatives, about $30 million for broadband infrastructure developments, and about $92 million for various other nonprofits across a variety of agencies. Somewhat uniquely, last year, we had significant dollars lapsing in the budget, largely related to the Medicaid program and additional federal support for that. We were lapsing general fund appropriated dollars. Of these, about $460 million in lapsing funds were carried forward and dedicated to other areas. See the by subcommittee how we identified them here. These included about $93 million for the Connecticut State College and University Systems, about $35 million additional for the UConn Health Center, about $6 million for UConn itself. There's an additional $50 million in the private provider account at the Office of Policy and Management. $40 million was dedicated for nursing home rate increases in DSS, and about $66 million was provided for Department of Economic and Community Development for a variety of nonprofits, about half of which went to the Connecticut Humanities Council. We tried to take a look at and categorize these as either one-time, definitely ongoing, or potentially ongoing. One-time expenditures are kind of self-explanatory. Things that are definitely ongoing, we identified things such as private provider rate increases, and things that could, as we deemed potentially ongoing, would be things like the support for the higher education and humanities. We wanted to highlight this as, particularly if you look in the second year, those potential ongoing expenditures may create some pressure on you as decision makers, as some of these entities who are utilizing these dollars in 23 might be have an expectation of them in 24. And those dollars are not built into our budget, the potential expenditures, ongoing expenditures. So that may be some pressure you will be feeling not this session, but next year in the next biennial budget that you adopt. Now we'll take a look at the out year projections. The fiscal accountability statute is very specific on how we have to report and calculate these out year estimates. Starts off with the November consensus revenue. That's the basis for everything we do here. Then the statute requires us to take a look at the previous year's expenditures. So for the out years, we'll be using fiscal 23. So that 21.5 billion becomes our base for the next year. We're then required just to look at areas of fixed costs and build those growth estimates into our calculations for this. We're then required to make a determination of what reductions in non-fixed costs would be necessary in order to bring the expenditures in line with the consensus revenue up top. This calculation would give us a required reduction of $931.9 million. Another way of looking at this is down on the bottom is more the traditional, just straight balance, what's your expenditure estimate versus your revenue. Creates the same thing in the first year, but you'll notice that in second and third years, 25 and 26, the unadjusted balance is actually going down. It's very different from when we looked at this in past years, if you recall. That's essentially because one fundamental thing, which we'll look at a couple slides ahead, has changed. Our fixed costs are growing at a slower rate than our revenue. So our unadjusted balance is actually improving as time goes on. Yeah, the question you should be asking on this one is, okay, 22 looked great, 23 looked great. How did we go from a $512 million surplus to a $900 million problem? In a nutshell right here, kind of complicated nutshell. This is the changes both on the revenue and expenditure side from fiscal 23 to 24. Over on the right, if you look at the top couple blocks, your structural balance between fixed cost growth and revenue growth, because the revenue is growing faster than the fixed cost, is actually helping you to the tune of about $211 million. There's several other technical changes, which they're technical. They have to do with timing of certain expenditures and revenues, helps you an additional $72 million. And down below, you have about $1.7 billion in revenue policies that basically mean that revenue that you had available in 23 under current statute, you don't have available in 24. The largest of this is federal stimulus. In addition to the allocations, the ARPA allocations we talked about a couple slides ago, the legislature opted to use ARPA dollars as revenue replacement to the tune of about $1.2 billion. We don't anticipate, and current law doesn't dictate that this would be available in 24, so that creates your first cliff. Secondly, and this is a little more technical in nature, the municipal revenue sharing account, it's an off-budget account that a portion of the sales tax goes to. In fiscals 22 and 23, the biennial budget, funds from that off-budget account were transferred into the general fund to support general fund appropriated MRSA-related expenditures. That transfer in the budget was only for 2 years. Those funds are still sitting over in MRSA. The transfer from sales tax is still going into the MRSA account. Those dollars are available, but current law in 24, 25, and 26, it doesn't transfer that back to the general fund to support the expenditures they're projecting. The third largest category is the expiration of temporary measures. These are broken out over on the right on top. The largest of which is delaying the historical gap deficit payment. There's also temporary restrictions on property tax credits expire, about $53 million, and temporary corporate business tax surcharge expires about $20 million. Lastly, there's a whole variety of other revenue policies that are currently in statute in the out years. I'm not going to walk through all of these, but they're again broken out over on the right. The largest of which is phase-in for the exemption for IRAs, which costs you about $32 million in revenue. And the phase-in in tax exemptions for pension and annuities cost you about $16.5 million. Let's take a quick look at the out-year revenue growth. And this is just the marginal difference in the several categories that were adopted in the consensus revenue. I just only point out the growth percentage, not spectacular by any measure, but solid 2.3%, 2.7%, 2.7%. Now, this is what we compare those fixed the revenue growth to. The table on top of the chart in the bottom, the same numbers. The top is just the marginal difference year to year. The bottom is the total estimates of the fixed cost. The biggest fixed cost is entitlements. Vast majority of that is the Medicaid program. Yeah, Medicaid and related expenditures. Current fiscal 22 is about $4 billion. The next biggest fixed cost is debt service, $2.4 billion, followed by state employee health and retiree, state employee retiree and retiree health, followed by the teachers' retirement pension and retiree health. The number that should jump out on you on this sheet is up top, the state employee pension and retiree health in red. This is a result of the transfers we talked earlier from the excess dollars in the rainy day fund going into the retirement accounts. Essentially, because we're making those deposits, we're going to need less in the appropriated actuarial determined amounts that we have to put into these funds each year. By fiscal 26, the end of this report, essentially, we will be required to, on an annual basis, pay about $300 million less in these retirement costs than we would had we not made those payments. We're expecting over the course from fiscal 22 to 25 that approximately $4 billion will be transferred into these retiree accounts. That represents about 9.7 billion or 9.7% of the unfunded liabilities in these accounts as of June 2020. So you compare, that's what I was talking about earlier, you compare the revenue growth versus fixed cost growth. I've been doing this for a few years, and this slide every year is the one that points out the trouble, because every other year that we've been doing this, the fixed costs have been growing at a faster rate than the revenue. If there's a takeaway in this whole presentation, I think it's this slide. This situation has been reversed. The revenue is growing at a faster rate than the fixed cost, largely because of the reduction in the fixed costs, again, largely related to those pension payments. By FY26, the revenue growth will have exceeded the fixed cost growth by almost $825 million. And no, this does not include the revenue above the volatility cap. This is just budgeted revenue that we can use. It's a very different situation from the last few years we've been doing this. I just want to point out a couple economic trends that are underlying all this. On the top of here, this is basically trends in retail sales. Up top is what we showed you last year, and no surprise, several industries, food and drink, clothing and clothing accessories were just having a terrible year, obviously. Non-store retailers, the Amazons of the world, as everyone stayed home, were doing well. Building materials, the Home Depots of the world were doing well as everyone was nesting. Fast forward a year, every industry here is doing very well, but it's interesting to note that the clothing and accessories and the food and drink, those that were doing worse last year, have bounced back the strongest. But at the same time, those that did very well last year are continuing to do very similar growth. Another one, someone has everyone scratching their heads, is labor market trends. On the left is an index of weekly, essentially help wanted ads. You can see that by this, the help wanted ads, employers are looking for people almost twice the pace as even pre-pandemic, let alone at the peak of the nadir of the pandemic. Yet on the right, the number of Connecticut employees has still not come close to, well, it's come back significantly from the nadir. It still has not come close to the pre-pandemic levels. It's just evidence of a mismatch between employers and would-be employees that we're all reading about. We see help wanted signs everywhere, and yet the unemployment rate hasn't come down at the pace you might expect from that. Lastly, we're just going to look at a change in employment from pre-pandemic by industry. Nothing too surprising here. Leisure and hospitality, the lowest paid area, has been the hardest hit. The ones that have come back most solidly are your construction, your trade, transportation. In a good sign for Connecticut, the highest paid, the financial industries. has come back almost to the point it was pre-pandemic. Now I'm going to take a brief look at the Special Transportation Fund, our other major fund. We're essentially projecting surpluses each of the 5 years that this report covers, varying from $110 million to almost $300 million a year. The cumulative balance, which is not exactly a rainy day fund, but it's somewhat equivalent, doesn't have the same restrictions, but basically any lapses at the end of the year, surplus in the end of the year, just built up in the Special Transportation Fund. It increases from about $241 million in the current fiscal year to about $1.2 billion in FY26. This fund has been helped in the current biennium FY22 and 23 by temporary federal support on the expenditure side of about $100 million a year. As well, on the revenue side in the current biennium, the motor vehicle sales tax transfer from the general fund has continued to increase. It peaks at 100% in fiscal 23. That has helped the solvency of this fund as well. And lastly, the implementation of the new highway use tax kicks in FY23 and is annualized by FY24, which also helps the health of this fund in the out years. Another look at the cumulative balance of the Special Transportation Fund. First column here is the average from FY10 to FY19. The cumulative balance is about 10% of the annual appropriation of the fund. As you can see, it's projected to grow significantly so that the cumulative balance will be just about half of the total appropriations to this fund. So in a nutshell, both the general fund and the Special Transportation Fund are looking pretty well. The FAR statute requires us to take a look at to project bond authorizations. The debt service figures underlying throughout this report assume about $1.6 billion in net new general obligation bond authorizations this year. Combined with the existing authorizations down below in the dark blue, it's about $1.92 billion annually in authorization, which is in line with recent norms. On the actual bond project spending side, this peaked at about $2.4 billion in 2016. That has been steadily trending down for approximately $1.45 billion in 2021. Lastly, the FAR statute requires us to take a look at tax expenditures. Several categories of tax expenditures. The largest by far, about 61%, is in the sales and use tax. Fiscal 22 would forego about $4.2 billion, $4.3 billion in revenue related to tax expenditures in the sales and use tax. We'll drill a little deeper into this one, explain what those dollars are. About 40% of the total is exemptions for consumer goods. The biggest of these, food products you're not paying tax on, prescription drugs, and motor vehicle fuel. The next biggest category is at about 30% of the total is government and nonprofit organizations. We don't like to tax ourselves. And lastly, the last large category is services. This is largely patient care as well as computer and data processing services. For anyone who is very interested in tax expenditures, OFA is required every 2 years to do a comprehensive tax expenditure report, and that new report is out next January. I believe we'll wait for any questions and answers after Secretary McCaw's presentation. I'd like to take a moment before that just to thank all the staff up in OFA for putting not just this report, but it's been a very interesting, challenging year and a half, and you really have a wonderfully dedicated group of state employees up here. I just want to thank them for that.
Thank you very much, Neil. We really appreciate all the hard work you all have done in OFA to keep the legislature informed on what's going on. It's been a pleasure working with you and your staff. So I see that Representative Betts and Representative Belinsky have their hands up. We are going to wait for questions. Do you have something relative to the process? But we'll wait for questions afterwards. Are you okay with that, gentlemen?
I am.
Mitch? Okay, great. Madam Secretary, I see your report is about 44 pages. I'm hoping that some of that is duplicative to what Neil has just gone over, so we could skip beyond those so that we could get to questions and answers. The floor is yours, ma'am.
Absolutely. Good morning and great to be here with you today. We do have an extensive PowerPoint, but that's available to you for your perusal in more detail after the meeting, and we'll hit the highlights as there will be a good fair amount of overlap. Let me go ahead and start to share screen. Okay. Excellent. All right, so quickly, the organization of this presentation is an update on the fiscal 22 projections, the estimates of our revenue fixed cost growth over the period of 23 to 26 for fiscal years, a quick snapshot at our long-term liabilities, and some highlights for conclusions and key takeaways as we think about the progress we're making with respect to the state's fiscal health. As of November 19th, we project a $894.7 million operating surplus. That's reflective of over $500 million in revenue improvement and additional expenditure savings of approximately $92.1 million. That is primarily due to the extension of the public health emergency, which is giving us an increased match on Medicaid expenditures for another quarter at 6.2 percentage points. As reflected on the screen, we're currently reflecting deposit to the rainy day fund of $1.863 billion. The withdrawal of $1.623 billion is reflective of the volatility cap deposit from last year, with a projected closing balance of $4.975 billion. The transportation fund is also seeing improvement. Current projections show an operating surplus of north of $250 million and a fund balance just around $500 million as we close out the fiscal year. As Neil, Director Ayers indicated, with respect to our fiscal 22 revenue changes that are in our consensus revenue, $380 million is related to federal grants and $155 million for sales and use tax, which essentially recognizes the strong closing point of sales and use for the last fiscal year. So we've trued up our revenue base to reflect the actuals from last year. The federal grants, large component of the federal grants is one-time in nature. It's recognizing the additional match that we're going to get, the 10% on the home and community-based services, which is a part of our ARPA, the ARPA plan for the state of Connecticut that's been submitted. So about $527 million of revenue improvement, largely federal grants. As we look to our recent revenue trends, we recognize it's early in the fiscal year that the stimulus resources are slowing, but we are, however, seeing that our revenue growth to date is outpacing our assumptions that we assumed, and therefore we've made a number of adjustments. You can see on withholding, we were assuming 2%, we're actually seeing 3.2%. Sales and use assumed 5%, we're seeing 10% growth. And then our two volatility cap related revenues, estimates and finals and pass-through entity also continue to outpace our original projections. So it is likely we'll see more positive improvement to our fiscal 22 revenue. We are currently showing deficiencies of about $55 million, offset by lapses of $164.5 million. Again, the largest portion is in DSS, extending the public health emergency, and we are net about $92 million in lapse projected for the year. This slide just gives a quick snapshot of our general fund structural balance. You can see for fiscal 22 that we are showing an operating surplus of $894 million, but reflected in that revenue balance, the revenue projection would be two major sources of one-time revenues. The first being the $560 million of ARPA revenue replacement that we use to balance our budget. And then there's the $150 million of revenue for the home and community-based program that we will receive one time and will be required to invest those dollars in over the course of the next 3 years. So the $894 million surplus, when you remove these one-time sources of revenue, it's about $184 million. And as we look to fiscal year 2023, as previously indicated, there's $1 billion, almost $1.2 billion in one-time revenues balancing the budget. After removing that from the base, there is a structural issue that will need to be addressed, or significant revenue growth that we would need to see to prevent a budgetary gap in fiscal 24 and beyond. A quick look at our estimated budget reserve fund. You can see us at the projected 4.975 billion. Obviously, 15% would be retained in the fund, and any amount above and beyond that would be used to pay down pension liabilities or outstanding bonded indebtedness. I wanted to highlight some of the recent narratives that are included in our credit rating opinions. As we all recall, the state did have its first rating upgrades over the past 20 years. And some of the areas that are highlighted that speak to the state's strong credit strength would be the governance improvements in recent years, the substantial reserves, our commitment to fully funding our ADEC, and the fact that we've gone above and beyond that with additional payments towards our pension liabilities. We're noted for how we've moderated our debt profile and slowed the rate of growth. And we are seeing the benefits of that as you look at the next 3 years and the pace of revenues to expenditures. And so these are the types of efforts that we've made that the rating agencies are applauding the state for. We are still noted for our high fixed costs relative to being highest in the nation. And obviously we're continuing to work on driving those particular fixed costs down. As we turn to the OPM projections of our fixed cost growth versus our revenue growth, first, again, as Director Ayers noted, the fiscal accountability report is not a comprehensive look at all of our expenditures. It is only our fixed costs. You can see that our fixed costs are growing faster than revenue through fiscal year 2024. In fiscal year 23, revenue growth of 517 million as compared to fixed cost growth of right around $1 billion, $994 million. Major contributing factors are debt service, our teacher pension, and our state and teachers OPEB, as well as the growth in Medicaid. On Medicaid, the significant amount of growth from 22 to 23 is because of the loss of the one-time federal dollars. So we were getting the additional match. And so as we go into fiscal year 24, that negative $1.1 billion, again, is the loss of the one-time federal dollars as well as other tax policy changes. So fiscal 24 is a particular difficult point with the increased fixed costs coupled with loss of revenue. But we start to turn the corner as we hit fiscal 25 and the years beyond, where the revenue growth is actually outpacing the spending growth. Quick look at our general fund revenue growth versus fixed cost growth. Again, you can see in 23 and 24, we have some challenges with respect to the growth of expenses compared to revenues. However, we begin to turn the corner, get a little bit closer in 25, and begin to balance out with revenues growing faster than our fixed costs. With respect to the special transportation cost, most of our fixed cost growth is driven by our rising debt service costs. So you can see that we have strong revenue growth in 23, 165 million, compared to fixed cost growth of 104 million. And as we go into the out years, 24, 25, 26, the growth in the debt service is outpacing the overall revenue growth in the fund. This slide is just highlighting for you that as you look at the general fund revenue, you can see that as we approach fiscal year 2024, total general fund revenues reflect a 5.4% decline. However, if we were to pull out the policy changes, the revenue policy changes, we'd actually see growth around 2.5%. As Director Ayers pointed out, this is a slide that just identifies for you what those policy changes are that are causing the reduction in revenue. And these are tax policy changes that have been enacted in law. The loss of the federal stimulus is a major contributor. The ARPA that's supporting our budget, 1.1 billion. The transfer of our surplus and carry forwards, $178 million. There is policy pertaining to the ability to use debt issuance premium towards capital projects. Right now, we use it to drive down our debt service expenditures. If the current law were to continue, then that would be a $60 million hit. And one of the other large items would be the MRSA full implementation of the 0.5% transfer to the off-budget account. So $1.9 billion in revenue loss based on policy changes, offset by $748 million of revenue growth, 2.5% revenue growth as projected here. As we look at our long-term obligations, we've just, as we all know, we've made significant efforts to reduce our fixed costs. Our bond issuance has been reduced to 9%. Our pension plans have been restructured and stabilized. We've restructured healthcare, and we continue to see entitlement growth that is modest compared to national averages. From a spending cap perspective, you can see what our actual spending cap growth rates have been historically, and the projections for fiscal 24 and beyond are around 3.3 to 3.85%. We're currently about $22 million below the cap in fiscal 22 and $35.7 million in fiscal year 23. Our long-term liabilities total $95.4 billion across our two pension systems, our overall bonding and outstanding indebtedness, as well as our post-retirement health and life insurance. General fund debt service, as you can see here, consistently, we are ranging from 11 to 12% of general fund expenditures for our debt service costs. In fiscal 22, we do have an increase of about $85 million. This is due to the teachers' pension obligation bond repayment schedule. And continuing into fiscal 23, the increase here is related to the another $103 million for the teachers' POB. And as we hit fiscal year 25, we're seeing the impact of the bond premium savings. And therefore, the bond premium would not be, again, used to offset debt service costs. Overall, as you look at our retirement system liabilities, you can see for SERS that 74% of the liability is related to inactive or employees who've already retired. 89% of our fiscal 22 ADAC is for the unfunded accrued liability. On the teachers' side of the house, similarly, 61% of the liability is related to our inactive existing retirees, and 79.7% is for the unfunded liability. This is a really great slide that shows us the progress that we've made on SERS and TERS. The top part of this slide, the blue line, shows what our ADAC would have looked like in the consistent increase year over year, the spike we were going to hit. And the orange line shows prior to the additional deposits we've made, but with the reforms, the structural changes that we implemented, how we have smoothed out the rate of growth of our pension annual cost. The green line shows the impact of the recent additional payments because we exceeded the budget reserve funds cap of 15%. The bottom slide gives a 25-year perspective of these additional payments that we've made. And it shows that we will have saved $3.45 billion in present value savings over 25 years because of these governance reforms and our current statute that ensured that the volatility cap was put in place. So we're relying on more fixed revenue, if you will, and taking that excess in those years to fill the rainy day fund and to make those additional pension payments. As you can see here, this discipline that we're employing, it's built into our law, will eliminate the unfunded liability in 2048 for SERS and 2050 for TERS. As we look to our Medicaid expenditures and caseload, we have seen significant increase in caseload. Our expenses have been moderated. Our per member per month costs are lower than anticipated. I would note here that we have adjusted expenditures to include any funds that were transferred to DSS from DMIS for behavioral health services, which might qualify for Medicaid reimbursement. And our estimates for fiscal 22 and 23 include the projected expenditures related to the ARPA Home and Community-Based Services Investment Plan and the substance use disorder. Overall, looking at Medicaid enrollment and cost trends, we do well compared to overall U.S. spending. We outperform spending. You can see that as we look at the enrollment and the caseload in Medicaid, that We have 9% of our enrollment as for the elderly, blind, and disabled. Their services represent about 37% of our overall cost. State aid to municipalities. This was a historic year with a significant increase in municipal aid. As we look at fiscal year 2021 and compare it to the muni aid in fiscal 2023, it represents about a 15% increase over that 2-year timeframe. As we turn to the economy, we did lose about 292,000 jobs during the beginning of the pandemic. We have recovered about 72.8% of the jobs that we lost. This slide shows the pandemic impact on employment by sector, leisure and hospitality having a significant impact here. Lost 90,000 jobs, regained 67,000, still some work to do to get them back to pre-pandemic levels. Education, health, and retail are other impacted industries that still have not returned to pre-pandemic levels. Connecticut's employment, however, compared to neighboring states, we are outperforming our surrounding states. 95.3% of jobs recovered. Latest economic forecast indicates that we expect to reach our pre-pandemic levels for our key economic indicators of GSP, wages and salaries, employment, that we expect to reach the wages and salaries by Q4 of 2020, which we've hit, and for real GSP, Q2 of 2022. Very quickly, this slide provides an overview of the Coronavirus Relief Fund, which were the discretionary funds provided under the CARES Act. It was a $1.38 billion award to the state of Connecticut. $1.3 billion has already been allocated, and there's about $47 million pending allocation. We are on track to fully obligate funds. We are finding significant levels of reimbursement from FEMA in the areas of PPE and testing, which may free up funds to support other areas. This slide is for your review at a later time, but it does provide you with an overview of the ARPA Fiscal Recovery Fund, which Director Ayers went over. We did allocate, you did allocate $2.579 billion, of which $1.2 billion was allocated for fiscal year 2022. Our agencies are working diligently to operationalize these funds and to ensure that we are contracting appropriately and meeting all internal control requirements. The ARPA Coronavirus Capital Projects Fund, the award is $141.5 million. Through the budget process, a total of $64.5 million has been allocated, leaving about $77 million remaining. Treasury rules, again, these projects have to be supportive of work, education, and health monitoring. The project has to address a critical need that was created as a result or exacerbated by the public health emergency. And we just recently received guidance from Treasury that the projects must be pre-approved prior to the award of funds and expended by December 31st, 2026. Treasury has not yet put out their application tool to submit our projects for pre-approval. So we have not made any progress on moving any of these dollars forward until Treasury makes that available to all states. A quick overview of the ARPA Home and Community-Based Services Investment Plan. I did send correspondence to our chairs of appropriation and Ms. Keene that I hope will be shared with you. Just to remind you of this investment plan, as you can see, significant amount of federal grants revenue to be received in fiscal year 22 with a investment plan that would need to occur through fiscal year 2024, 25, 26. The amounts that are reflected here in spending will need to be appropriated across the state agencies. We expect about $19 million for the HCBS plan of additional appropriations that will be required this year. We'll be looking for FACs to offset. And then as we go into the next fiscal year, $160.9 million of increased spending as a requirement of receiving the additional matching funds. Similarly, the substance use disorder waiver, it's 1115 waiver. The DSS has been working on this in partnership with DEMIS and other sister agencies to maximize federal reimbursement for expenditures. The waiver has been approved. And this is another area where we will get increased grants revenue, and we will need to reinvest them back into services. So some appropriation adjustments will be required. I won't go into detail here, but just flagging for the Appropriations Committee, the increased infrastructure funds, about $6 billion that will be coming into the state of Connecticut. These funds will, we have a match, so there will be additional matching requirements in the transportation fund, in our geo bonding for DEEP, for public health. We're beginning to review in further detail that will have some fiscal impact on our planning for next year. And finally, slide 43, Senator. Again, key takeaways: we are currently projected to close fiscal 22 with a surplus of $894.7 million. That is by and large primarily driven by improved revenues in sales and use tax and federal grants, of which there are some one-time revenues in the federal grant side of the house, and some surpluses in the general fund, particularly in Medicaid due to the increased match that we're receiving for another quarter. We are seeing revenues outpacing targets. Just to flag that there's some non-recurring federal grant revenue in there. Absent the one-time funds, the general fund would have a surplus of about 1%, but close to $1 billion deficit in fiscal year 23 if we were to pull out these one-time dollars. And so we will need to experience significant revenue growth to prevent a large budgetary gap in fiscal year 24 and beyond. Our rainy day fund has more than $3 billion. It's at our 15% target. And we will continue to use excess to pay down pension liabilities, which will reduce cost in the out years and help us to achieve further balance. Our fixed costs, they're rising faster than revenue in fiscals 23 and 24, mostly due to our reliance on one-time federal aid or the timing of, for example, the home and community-based services one-time revenue. But we are finally starting to see our revenues and our fixed costs being aligned in 2025 and 2026. That is an incredible note for us, incredible progress that we're moving in the right direction. Our spending cap is projected to allow growth of 3.3 to 3.9% per year. This does, however, exceed the level of revenue growth, so we'll need to address that. And finally, our future budgetary choices will certainly be impacted by what the level of organic revenue growth that the state achieves to replace our reliance on one-time revenues. So with that, I want to also acknowledge the OPM Budget Team that does all the hard work, and want to for an exceptional work product. At this time, we'll take any questions you might have.
Thank you very much, Madam Secretary, and thank you for working with us all. I have a couple of questions, and we'll start out with 2 questions each. We'll start with the chairs and ranking members of the 2 respective committees. Last year, you gave us, Madam Secretary, a number of saying that we were down to about the 1950s level of state employees. With the number of people that are leaving, where do we stand now on the number of people that are leaving? What is the anticipated loss? And ultimately, a change in how we are paying those people through the pension system.
Senator, thank you for the question. We're happy to provide updated estimates on where our filled count is relative to historic levels. We know that over the years, there have been significant decreases in personnel across the state agencies. There are a significant number of vacancies that are under recruitment, particularly in our areas of direct care. We know that the healthcare industry is struggling with finding personnel for these particular roles, and that's something that impacts state government and certainly outside of state government. So the Department of Administrative Services is working very hard with the sister line agencies on those recruitments. We also are identifying areas where there's risk. You'll recall the CREATES report identified areas of significant risk where we would see a lot of retirements. So some of the changes we've made to support state agencies are to give more flexibility on approval of high volume positions to expedite the hiring process. The state still has challenges on recruitment, but we're supporting agencies the best that we can, along with the Department of Administrative Services.
Thank you very much. And this question would be for the Executive Director, Mr. Ayers. Mr. Ayers, looking at the out years, right now the slides that I saw anticipated a pay down in pensions. It seems to me that we will have an even another 2 years of paying down our pensions at the same level. How does that seems to me to be like the best news that we could have, relatively speaking. Where do you see us in our pensions and our pay downs and our pension liabilities over the next 2, 3, 4 years?
I believe we're estimating by fiscal 26, the last year of the out years, your ADEC would be roughly $300 million less than it would be otherwise had we not made the payments we're anticipating to make.
And is that those dollars, are they already included in the budget, or would they be added into the budgets in the out years?
Well, there isn't a budget in the out years. Right now, they're just estimated.
Right.
So that would essentially, if you're talking with regard to a spending cap, give you more space for things that are not the pension payments.
Thank you very much for that, Neil. Representative Walker.
Thank you. Thank you. Thank you, Senator Boston, and thank you, Madam Secretary and Executive Director, for your presentation. It's kind of funny because when I listen to the presentations, I have different balances of thoughts that kind of go. And my first comment, one of the scariest statistics I saw on the whole thing was the fact that the number of teachers in our educational system in the state of Connecticut is still reduced dramatically. And we need to make sure that that needs to go up to the front of the line as far as what we look for in employment, because if we don't have teachers, then our state is in major trouble. I think it was 51% that we were recouped, and that scared me. I did not realize that. But continuing with what Senator Austin was talking about the CSRS and TERS payments and things, I think it's important for some of us who don't know finance that well, but understand the impacts of it, that we understand exactly what does that mean, because listening to your presentation, Mr. Ayers, you basically said that it was going to be about 300 million by 2026 that we will acquire in room, 300 million in room for spending in our budget. But yet, as you look at it going forward, how does that impact and how does that happen? How do we see room from payments from the TERS and CSRS that would be beneficial for us in our budget process?
Unlike for much of the history of Connecticut, for the past decade plus, the legislature and the administration has agreed to fully fund what the actuaries say is necessary to make a payment each year for the retirement systems. When you're making additional payments over and above what the actuaries say are necessary, when the actuaries look again, because our unfunded liability will be lower, the required annual payment will be lower.
So does that continue the conversation? So that translates to?
You would have to appropriate fewer general fund dollars for state employee retirements or teacher retirements, depending on where the deposits are made.
Okay, that's what I was trying to say. So, Madam Secretary, when you did, I think yours was slide 12, I got a different focus on what Mr. Ayers pointed out. When you did a presentation, it had a little bit more. Can you give us a little bit of elaboration on what your scenario was in that, please?
So I'm in 100% agreement with Director Ayers. The more we pay down the unfunded liability, your annual payment will be lower. So it helps to slow the rate of growth of our cost. Slide 12 was really looking at the additional revenues year over year that would be coming in relative to how fixed costs are growing. And in the first year in fiscal 23, we see revenue growth of over $500 million. We also see fixed cost growth of close to $1 billion. And half of that billion, Representative Walker, is increase in Medicaid spending. Remember, Medicaid is net appropriated. So a portion of that increased cost is because we're losing the extra match we were getting from the feds. The other major components that are contributing to that $1 billion of cost growth would be debt service, increased costs, teachers' pensions, and our OPEB costs. So the story in that slide is our fixed costs are growing faster than our revenues. It would be worse if we didn't make these pension payments, right? And we're seeing that also in fiscal 24, mostly exacerbated by the fact that we are using one-time revenues to balance our budget. The $1 billion for the ARPA, and then any other federal aid. The tide changes as we go to fiscal year 25 and 26, in that we're seeing revenue growth of at least $500 million, and our expenses are only rising by $300 to $400 million. And that's because by the time we get to that year, we no longer are significantly reducing our revenues or pulling out those one-time revenues. And then the rate of growth of the expenditures is slower. We start to get to level funding for CSRS. And we have obviously throughout this process, we're capturing the savings because we made those additional payments, and it creates the lower annual cost in our pensions.
Okay.
So I think the message is the same. We're getting to a really good point as we get to fiscal year 25. We're going to have to get over the hurdle in 24, and then we begin to see fixed costs very balanced against revenue growth as projected.
So the revenue growth is subjective. We have the control over that and how we go from that. Okay, got it. Thank you, Senator, for allowing me to ask those questions. I'll get in the back of the line and come back again. Thank you.
So I just want to make sure that we're all talking in apples to apples. You've added in the Medicaid costs to the fixed cost growth when really our pensions are going down, and most people consider the pensions and the healthcare the fixed cost. You've added in the Medicaid spending, which is different than Neil's report. Would that be fair, Madam Secretary?
We do include entitlement programs. Any entitlement related programs we include as fixed costs.
And then if you could just separate that out as we move forward, that would be helpful, because I think people are getting confused. Next is, I don't know if Senator Minor made it on. Well, I know that Senator Francis unable to be, Representative Francis unable to be here. Senator Fonfara, followed by Representative Scanlon. Senator Fonfara, do you have any questions? I know I saw John come on. Representative Scanlon, your questions, sir?
For Director Ayers, two questions. First, when is the last time that our revenue growth percentage outpaced the fixed cost growth in history? How long ago?
Off the top of my head, a very long time. I don't know the exact time. We can look into that for you.
Decades, would you say? Years?
I would assume so, yes.
Okay.
It's been a while.
And then secondary to that is that in the January consensus revenue that's coming next month, or I guess 2 months from now, technically, is it your understanding that there may be, given enhanced revenue collection in the recent past, that revenue growth will show up on that consensus revenue report as a means of downgrading the 24 deficit?
I don't want to speak out of hand. That's discussions between our office and the Office of Policy Management in January. I believe Secretary McCaw did touch on the fact that we adjusted federal revenue, we adjusted sales tax revenue. We did not adjust income tax revenue. That has looked positive. There were some flags given early in the year that I think both our offices wanted to confirm before we made adjustments related to that. But I would say in general, that revenue stream is looking positive and very well could help you out current fiscal years as well as the out years.
On the withholding side, correct?
We didn't adjust withholding or estimates of finals.
Okay.
But for purpose of helping budget, it would have to be on the withholding side because we're already above the volatility threshold. So anything on estimates and finals would just flow into the rainy day fund.
Okay. Thank you, Director Ayers. Thank you, Senator.
Thank you very much. Is Senator Martin on? Representative Cheeseman.
Thank you,
And
Sen.
And Representative Cheeseman, I'm sorry, I keep forgetting to say the next two after that. We will start with Representative Betts and Representative Belinsky after you.
Thank you very much, Senator. Thank you, Secretary, and thank you, Neil Ayers. Two questions, both inflation related, one for each of you. Secretary McCaw, when you are looking at your figures going forward and looking at salaries, which I believe are not included in fixed costs, what, if any, adjustment are you making in terms of, I believe we're going to be doing new CBAC contracts in 2022 for inflationary pressures and what effect they may have on salary demands?
Representative Cheeseman, you raise a great point. The OPM report does not include the personal services wage increases as they are dependent upon negotiations. So when you're looking at the fiscal accountability report, that is not reflected in OPM's estimate. I would not be able to speak publicly as to what we're planning to include as we're still at the bargaining table with CBAC concerning an updated wage package. That will, however, depending on how the negotiations go, could be included in the governor's midterm budget adjustments.
Thank you. And for Mr. Ayers, again, when you're looking at these figures, both in terms of expenditure growth and growth in revenue, what allowance are you building in for the increased inflation we're taking? I know when we received the consensus revenue estimates, a large part of the growth we were seeing in the used car sales tax revenue was due to the inflation in the price of used cars. So I'm just wondering how, as I said, these inflationary pressures may or may not factor into the report that you presented to us.
I think I believe we discussed this when we were discussing the consensus revenue. I don't believe we can disaggregate inflation versus the other factors, particularly in our sales tax increase. It is obviously a part of increased revenue if it's a taxable good that's increasing in cost. But I don't believe we can disaggregate the impact of volume versus inflation necessarily the way we get the data. And as Secretary McCaw said, on the expenditure side of things, the fiscal accountability statute somewhat puts us in a bit of a straitjacket on how we project. The areas that would likely see inflation, like agencies, other expenses, something along those lines. By the fiscal accountability statute, we basically are required to flat fund them for purposes of this report. So where our analysts would probably be looking at inflation, this report doesn't reflect that.
Okay, thank you. Thank you very much for your answers. Thank you, Senator Austin.
Thank you very much, Representative Cheeseman. Representative Betts, followed by Representative Belinsky, followed by Representative Meskers.
Thank you very much, Madam Chair, and thank you, Madam Secretary, and Neil, for your very comprehensive explanation of where we are financially in the state. I have two questions. One, and I don't know who should be answering this, but one has to do with the projected revenue that we had thought was going to come in the budget about tax increase on gasoline. And as we all know, it's gone up substantially. And my question is, how much more money have we collected over the budgeted amount? But more importantly, can any of that money be transferred out of the transportation fund, or can that money be used for other purposes than transportation?
So Representative Betts, you may recall that the Transportation Fund has a constitutional lockbox. And so no, once the revenues are in the Transportation Fund, they cannot be removed. We have seen improvements on our motor fuels tax projections. We're projecting about $490 million for fiscal year 2023. We are obviously still monitoring what the new norm looks like for commuting to work and things of that nature that would impact the volumes of sales and the revenue progress. Now, with respect to your question, I believe you might have also been touching on the highway use fee. The assumed annualized revenues are around $90 million. What I will flag for you on the transportation fund is, while we've outperformed our revenue projections, also in the oil companies tax, that's helped us to create and restore fund balance. You might recall that some of our prior projections, we were going to get very thin and lean in the transportation fund. So we have restored some fund balance there. We're projected to see that grow, but the debt service costs are going to outpace the revenue growth. So the sustainability of the fund does need to see that growth in revenues. I think that's very important for long term, particularly as we go into this time frame of infrastructure, and the state is going to need a significant matching funds. One more tidbit for the committee: the amount of funds that are coming into the Department of Transportation alone will require $80 million more annually in match, and that's for the formula grants. For the competitive grants, that number could be up to $100 million. Those additional expectations are not reflected in our projections. So we'll have to account for that as we go forward in the midterm budget.
Thank you very much for that detailed explanation. That's very reassuring in many senses. The second one has to do with probably more with OPM, but it deals with the mental health system. And we've heard for years that it's overwhelmed, that we don't have enough money to hire psychiatrists or find beds for people who are looking for it, particularly in addressing the multiple problems that have come from COVID. And I'm wondering how these funds, particularly from the federal government, can be used to either hire more people to meet this demand, or is there a plan for the next 5 years to say, okay, here's where we are now. We know the demand is extremely high. The need is urgent. What are we going to do over the next 5 years to address that problem?
Thank you, Representative Betts, for the question. First, I want to acknowledge that you, in the enacted budget, made some progress with respect to mental health private providers and providing rate increases to support the salaries. We know that attracting employees into this field is really hard. So that's great progress. We made some progress on the children's behavioral health side in our ARPA plan, where there are resources to establish urgent care crisis centers, to really deploy mobile crisis teams out into the community to be on site when issues present. I would say that there's probably opportunity to do a little bit more on the adult mental health side of the house. We'd like to reevaluate or go back to some of the proposals that the governor had put forward to do similar things on the adult side of the house. When we look at our service delivery system, DEMIS tells us that there are gaps, and the gaps are, if you can't get into a provider, or you can't get the service in the emergency department, we need to create more service delivery options. So similar to the children's behavioral health, we need urgent care crisis centers and more mobile support services. We did it on the children's side. The administration feels we should also do so on the adult side as well. The ARPA funds, there's over $200 million that's remaining, would be an opportunity for us to reinvest or to put some resources into that area, because we know that mental health has been exacerbated by the pandemic, and therefore that would be an allowable use. So we look forward to those discussions with you as we go into the next session.
As do I, and thank you for that. I think that's really important. And I want to thank both of you again for your hard work in providing the information. And thank you, Madam Chair, for allowing me to have those two questions.
Thank you, Representative Benson. I just want to let everybody know that Appropriations has some informational hearings happening on both the children's behavioral health and adult mental health forums that will happen, one in December and one in January, before the budget, to get a comprehensive look at the dollars that we need. I hope everybody's able to attend. Representative Belinsky, followed by Representative Meskers, followed by Representative Nolan.
Thank you very much, Madam Chair. And I have to also begin by saying, well, first of all, we've addressed many of my questions to some degree at this point, but the comprehensive and easy to understand presentations by Mr. Ayers and by the Secretary McCaw have been refreshing. And the good news that we are hearing in the subtext of both of the reports is actually very exciting. So thank you very much for the clarity. I have a couple of concerns about our economic projections on the basis upon which we are calculating our revenues going forward. And we did address this, and I'm not even certain who I'm addressing this question to. At first, I had made some notes while Mr. Ayers was speaking. For instance, in slide number 16, the analysis of the retail and market trends, which feed into sales and use tax. When we were looking at the 2021-2022 recovery, as I dare say we've been calling it, are we simply just seeing that the economic performance is reflective of increased revenues that are coming in from sales and use tax because of a new inflationary valuation of everything that consumers are buying? So, is there another way to look at this, with a historical basis year so that we can know just exactly what the impact is and what we can expect going forward, and when we're going to stop experiencing what I interpret as being artificial revenue growth, because it's very dangerous to me if we allow our spending to accelerate to economic growth projections that may not stick. So that's the end of that very long question. And anybody have any thoughts about that?
I'll take a shot. The bubble graphs we put in there on the industries were to try to provide you some context. We don't directly project off of that. We rely strongly on actual receipts. I think about the fourth slide, where we show the large spike in sales tax, both our offices do the consensus revenue are assuming that's one time in nature, and we're going back to in sales tax, a more traditional 2.1, 2.2% growth in the out years. I guess to your point of a baseline with which to compare, I don't believe either of our offices have ever tried to project through such a volatile and unpredictable 18 or 24 months that we've been dealing with. I think the sales tax for the current fiscal year went from 10% growth last year. I think the consensus is assuming about 5% this year, and that's based on what we're seeing coming in. It's actually been relatively strong. I think that maybe it's somewhat conservative for the current year, but we're projecting it to go back to norms in the out year.
I would echo what Director Ayers said. Obviously, we look at the current trends of where they're coming in, but historically, sales and use has trended around 2 to 3%, and we've used low 2 percentage point economic growth rates. We think that's conservative. The fact that we have our, multiple time points in the year to do consensus revenues allows us to gauge whether or not the assumptions we're using are accurate and to adjust that accordingly. So we're on solid footing with the level of conservatism that's been built in, and we'll monitor, January and April again to see if we are moving in the right direction with the assumptions that have been baked in.
Okay, thank you. I thank both of you for that answer. The discipline of it, and being able to look at it for what it really is very, very important to me. I'm also very proud of the work of the Appropriations Committee in considering the one-time revenues that we had this year and all of the need that we've had over the pandemic period. Appropriations has been a very they've taken a very conservative, very cautious approach to the way that we're spending our money, so that we're not creating permanent permanent programming liabilities around it. So hats off on that as well. I'm also very happy to hear that the Special Transportation Fund is showing signs of health and will be able to help us support the infrastructure investments that are going to be made. Being that we do have surpluses projected in that Special Transportation Fund, there's been a little bit of mention about the truck tax, the heavy highway user fee that's phasing in. With the stability that we see in the STF, and with the acknowledgement, or at least on my part, that that truck tax is going to contribute to the cost of goods bought, sold to the economy, and will have direct consumer impact as something that we can control versus inflation, which is something we cannot control. Is there some consideration, or is there some possibility of us tabling that tax and not putting the additional burden on the taxpayers of Connecticut to have us contribute to the inflation of the goods and services of FA purchase?
I'll take that one. Representative Belinsky, obviously that's a discussion for the next legislative session. I will say the following as key takeaways from the fiscal accountability report. One, the revenues are not keeping pace with expenditures. So the solvency of this fund long-term is still an area of concern if we start reducing the recurring revenues. Two, we are going to have to leverage the infrastructure dollars. It's an unprecedented opportunity to make investments across the state that I would not recommend that we miss that opportunity. And so that will have increased expenditure requirements that are not reflected in the reports that you have here today. So I think it's important to look at our long-term vision for the state, that we're making decisions that ensure we're moving forward, similar to what you're seeing on the FAR for the general fund, where revenues are keeping pace with the expenditures. We ought to ensure that we are providing an infrastructure for that to occur in the Special Transportation Fund. We obviously will do an updated projection as we go into February and look at the fund over the next few years. And we'll share that with you, and OFA will do theirs as well. But long-term sustainability is an area that our rating agencies flag. The fact that we finally secured a funding source to demonstrate how it is we're going to continue to make the investments that are in our capital plan are very important. And we'll obviously continue to monitor whether or not revenues continue to outpace projections. So that's a discussion I'd say for next session, but the governor will want to see long-term sustainability for the fund.
I understand that. So thank you very much.
Thank you.
Thank you, Madam Chair. Thank you to the Secretary and to the Budget Director, and again to the Appropriations Chairs and the rest of the Appropriations Committee that I have the pleasure of working with. We didn't get here by accident, and it's very reassuring to hear numbers that have upside to them. So thank you very much. I appreciate it, Madam Chair.
Thank you very much, Representative Belinsky. Up next is Representative Meskers, followed by Representative Nolan, followed by Representative Borer.
Thank you, Madam Chair. I've got two principal questions. First is a comment. I'd like to thank Neil and the Secretary McCaw for the presentation. I think clear, succinct, professional, as good as anything I've seen in my personal career. So I want to thank you for that. Past financial documents I've reviewed, you know, when we talk about the problems of Connecticut and sustainability, in the prior reports I've seen, they mentioned approximately 38% of the revenue stream, I think going back maybe 2 decades, was to fixed operating costs, and about 62% went for the operating budget of the state. I think we peaked out at 50 or 51% in terms of fixed versus discretionary spending or operating spending. Could, as a first comment or first observation, could you tell me how we're doing on that in light of the pay downs and the obligations? The second piece of that question is I understand that about $1 billion in pay down frees up about $100 million of operating revenue. Is that more or less the ratio? Is it 10 to 1? So if I pay off $1 billion through the rainy day or through the excesses in the rainy day fund, I free up about 100 million of expenditures. Is that how I should look at that? That was my first question.
I believe that is roughly accurate.
Yes, I agree. That sounds like an all savings across all funds.
Yeah.
I think it's maybe about 75% of that would go to the general fund and the remaining 25% to the other funds. Looking for Greg to confirm. He's nodding yes.
With regard to the fixed costs, we have them at 51.9% of the budget in 22, growing to 55.4. Again, that's somewhat how this is structured because we're only allowed to grow the fixed costs. That's not how you would necessarily pass a budget. There are other spending demands in the non-fixed side of it. So that percentage is, I think, a little skewed.
And that's mostly because of entitlement growth there?
We had a chart in.
Yeah, so I'll ask you.
Entitlements is by far and away, not by far and away. It is the largest area, followed by debt service.
So it'd be helpful going forward, just if we could see what we're doing in terms of the fixed costs we control within the boundaries of Connecticut versus federal obligations. Because my assumption is that as we're paying down the fixed debt, that we're getting more, whether it's going into the entitlement programs or operating expenditures discretionary, that more of the resources are getting to the Connecticut residents versus debt service. So that would be helpful to see that in some kind of trending chart over the last 10 or 15 years.
Okay.
All right, but my second question and comment, as I've looked at the budget and talked, there's a curious lack of dynamic scoring on the operating revenues of the state. So, Melissa, I thought you were very helpful. I think you talked about a total of about $180 million in calls or draws on the Special Transportation Fund. 100 million, I think, or I wasn't sure whether it was 80 or 100 was on the fixed amount of transportation spending from the federal government. And then in potential another 80 million, which would be those programs that we have to apply in grants for. So structurally, the two issues are, how much, do we have any idea what the multiplier is? I mean, the ratio I'm assuming must be enormous. It's got to be what, a 5% match from the state to 95 from the feds, if the ratio is as big as I'm hearing about, what, roughly 6 billion from the Fed. But I'm just trying to get a sense of the magnitude there, and if we have any idea how much of that will generate within the state, the gross state product. So I'm concerned that what the ratio, the amount of call we have in this new money. 2, what kind of economic impact it will generate, and 3, obviously, we need to be able to get the right grant writers in place to make sure that we maximize the discretionary amount we get out of the federal government. I know that's a mouthful, and I'll probably be torturing the DOT on that going forward, but I wanted your view on that from 30,000 feet.
Absolutely, Representative Meskers, and Commissioner Gelati will welcome that torture. So just to clarify, based on the infrastructure bill should be viewed as baseline funding that has been plussed up. We anticipate, based on the increased amount that we will be receiving for the DOT, that will require for the formula grants an additional $80 million match per year. On top of that, we do anticipate a significant amount of competitive grants that will be available in the neighborhood of $1 billion. Obviously, the department will be evaluating which of those we'd be interested in going after. We are currently looking at existing plans or designs that are ready so that we can be at the front of the process and show Washington that we're ready to go, and identifying what those projects would be. On the DOT competitive, which we estimate at $1 billion, there's no specific amount. It's based on 1% of the funds being available, given the Connecticut's population. Those matching amounts and the percentages are not yet specified. It will be grant by grant. We know that typically DOT grants require a state match of about 20%. So that could be anywhere in the neighborhood of, 50, to 100 million. So this is an area where we'll have to monitor. Sometimes we can identify state funded projects that already have the match funded in the transportation fund. So with respect to what's coming in and what we think will be to match, those are the answers to your question. We have been working for the past three months on evaluating what staffing needs DOT will need to have in place in order to ensure that they're ready to move those projects. And the department has identified north of 150 positions of inspectors and engineers to ensure that they have the staffing in place. We will be requesting through the budget process a technical adjustment to support those positions. They are also eligible for federal reimbursement. So the cost to the state is only 20% on those positions. It's a rather low cost. We're estimating maybe around $4 million. The process to hire, they have existing capacity to begin those hires. They will be submitting those to OPM to start that process now. We cannot wait until next July to go after the funds and ensure we have the staffing in place. So we're using the resources that are available to allow them to start the hiring. We might need to do some FACing to ensure that the funds are in PS to support those costs, and then request a technical adjustment through the next year's budget process. We're doing the same for DEEP and the Department of Public Health as well, to ensure that they have the requisite staff in place to support the infrastructure grants that will flow to Connecticut.
And the issue on the dynamic scoring, any chance on that? The idea of, this is the most stimulus we've had coming into the state from the federal government, I don't know how long.
Significant number of years. It's a great question. We have not yet begun to think about how that investment in the economy, what the output looks like, and how it impacts our projections. But certainly one we'll take back and do some follow up on.
All right. Thank you very much.
Thank you.
Thank you, Representative Meskers. Representative Nolan, followed by Representative Bora, followed by Representative Carney. Anthony, you're muted.
Hi, so most of the questions I had were asked. I just want to thank Secretary McCall and Neil for the information they put out. A question that I did want to go back to with Neil is on slide 8, I believe, of your presentation. I was trying to figure out the 11.5 for the unknown in the ARPA funds. Could you explain that? What is the unknown, and is that 11.5 million or 11.5%?
It's 11.5%. We know what all the expenditures are. I think it's more of an unknown what category it would necessarily fit. We can get the breakout of what's in that pot for you.
Okay. And Secretary McCall, you talked about the high fixed cost, and I heard you say what some of the high fixed costs are, but is there a list that can tell us what they are and a way of how we're combating those high fixed costs, and like brief explanation so we can have an understanding about that?
Yes, Representative, we will happy to provide some of the backup, as well as we can share with you our rating agency opinions. Primarily, the high fixed cost are pensions and debt service. As far as what we've done to improve that, we have restructured both pension systems. We reduced our investment rate of return, and that's important because if we don't make the investment rate of return, you have to make up those losses in future years, and it increases the annual amount that the general fund and the other appropriated budgets would have to pay for. And on the debt service side of the house, we have been able to live within 1.6 billion of issuance. The amount you issue drives your debt service costs. It's the amount you're borrowing that you have to pay back over 20 years. So as we think about those fixed costs, certainly pension and healthcare, we do monitor our entitlement growth, Medicaid, and how those costs are growing relative to revenues. Those are the primary cost drivers that you see in our fiscal accountability review report. Also, the other employee benefits. So those are your health benefits after you retire. But for pension and debt service, we are praised by the rating agencies for the progress we've made, as well as the additional payments towards unfunded liability. I mean, Connecticut is leading the nation with some of these governance measures that have been put in place from 2017 forward, and it's creating fiscal discipline that's allowing us to see results that are paying off, and it will help us to in the future to be able to make investments in other areas. You know, once we get past that 24 timeframe, and be able to make investments in other areas that are important to the executive and legislative branch. So we ought to be very proud.
Oh, thank you for that information, and I'll look forward to possibly talking to you offline just to understand a little bit more. Appreciate the presentation and the hard work that is going on in both OFA and OPM. Thank you.
Thank you. Always available.
But thank you very much, Representative Nolan. Representative Bora, followed by Representative Carney, followed by Representative Nuccio.
Sure, thanks. Thank you, Senator, and thank you both to Neil and Secretary McCall. I think most of my questions were answered around the infrastructure funding. I didn't realize that we would have to provide a state match, but that makes sense. I'm wondering, it might be too early to tell, but my question for the Secretary is, do you think that the cities will need to, in the competitive grant process, apply through the state or apply directly to the federal government for funding for the project needs?
Representative Bora, good to hear you today. It likely will be a mixture. However, as we begin to look at some of the funds that will come to Connecticut, there will be opportunities for the state to partner with local municipalities, whether it's through grant applications or through braiding funding sources to address an infrastructure need in a community. We're still in the very early stages of evaluating the bill, and we really need the guidance to come out. But we have our team in place across the agencies that have begun to think about how to take the areas of investment and break them up into themes, if you will, whether it's clean water, or transportation infrastructure or broadband, and figure out how to work across state agencies, but also how to work across government level, state and local. So that is a work that is in progress. And the governor will be making some announcements very soon on the structure of how he's looking to operationalize those funds and ensure that we have stakeholder input that's just not at the state level as well.
Okay, that's good. That's great. So when you mention the hires that we're going to invest in order to facilitate and make sure we leverage every dollar that we can, is part of that potentially facilitators to help with the cities? Because, you know, it's a complicated process and difficult sometimes to navigate, and it's new. So just a point person in the different areas so that 169 cities are not trying to figure it out, you know, in silos and independently. Just as you hire those folks, if you can consider, you know, point persons that they have a direct number to help them and navigate the process and to apply, I think that would be worthwhile.
I'll take that back to the leadership team. That's an excellent point.
Okay, great, thank you.
Thank you very much. And I would point out that there are probably over 300 empty positions that have funding available in the Department of Transportation. That has been a long-term problem, hiring engineers and other folks When we're talking about these numbers, everybody should remember that we did put in a number of dollars relative to personal services in the Department of Transportation to make sure that we were going to be able to take advantage of this infrastructure plan going forward. I just wanted to put that out there. Representative Carney, followed by Representative Nuccio, followed by Representative Devlin.
Thank you very much, Senator Austin. Thank you, Melissa and Neil, for your presentation. I just have two questions. The first one regarding the ARPA funds, how will it be determined, or who will determine where, I should say, generally where the money goes, but also more specifically the 20 million or so to specific individuals? Like, how will those people be chosen? Through you, Madam Chair.
Representative, so first, you will recall in the budget that was enacted that the legislature had specific allocations for programs or initiatives that would be funded with the ARPA dollars. Now, with respect to your question on the individuals that would be funded, is there a specific allocation you're referring to?
It's like 20, I'm sorry, it was like 20 or so million. And it just, I mean, individuals, it said. So I'm just wondering what the definition of that is.
Are you, excuse me, Representative Carney, are you talking about the pandemic pay?
Yes.
Okay.
I'm sorry.
I'm just trying to
I
make sure that
apologize.
we all know what you're talking about.
Hero
So
pay.
it's actually
Yes.
$22 million, 12
Okay.
million and 10 million. One was for the National Guard and one was for state employees that the administration is getting us those categories of people. It wasn't really individual people, categories.
Okay,
The
I'm sorry.
National Guard, relative to the National Guard, those that have been activated, I think that there was a formula instituted in that, and relative to the state employees, we're all waiting for the job classifications. I think there's still, the administration is still evaluating that. Would that be accurate, Madam Secretary?
Senator and Representative Carney, the pandemic pay is subject to negotiations with labor. So as far as the individuals or the job classes, we are actively in negotiations. And once that's finalized, we'll share that with you.
Okay, I appreciate that, Secretary.
And Madam Secretary, there would be no
Yes.
negotiations relative to the National Guard.
That is correct.
So that money would be released at what time?
We would like to see the conclusion of the pandemic pay for the non-National Guard employees, just so that we can evaluate what we negotiate there relative to what we'd be offering the National Guard. So we're trying to sync the timing on that. We are still in negotiations with labor. We're also in active negotiations for their economic package, and we just finished up, negotiations for mandatory vaccination. So the bargaining table has been pretty busy. But as soon as we have an update, we'll ensure that we get that over to you to ensure you're fully informed.
Do you have any other questions, Representative Carney?
I just have one other question related to the Special Transportation Fund slides. So I'm just curious regarding the increase in gas prices. I mean, how is that playing into getting that additional? I know the 8.81% for the gross receipts taxes. So I'm assuming you're using a higher gas price for your projections based on the current gas prices, through you, Madam Chair?
Yes, we are. That is correct.
Okay. Are you anticipating gas prices continuing to rise in your scales, or no?
We are continuing to monitor. We've reflected the most current prices that the market is showing, and then in January we will evaluate whether or not there's additional price increase.
Okay. All right. I appreciate that, Secretary McCaw. And again, thank you and Neil for your presentation.
Thank you very much, Representative Carney. Representative Nuccio, followed by Representative Devlin, followed by Representative Mashinsky. Representative Nuccio, the floor is yours.
Thank you, Senator Austin. I appreciate that. Thank you both to Director Ayers and Secretary. I just promoted you. Look at that, Secretary McCaw. I have a bunch of questions, so I'm going through my notes, trying to narrow it down to two. The first one is, I think we mentioned it. This one's more like a comment, and I think maybe Senator Austin tried to clarify it. I'm a little confused because Secretary McCaw, you had said our fixed costs were growing higher, faster than revenue. And then Director Ayers had said our fixed cost was growing slower than revenue, but also that, we have the highest fixed costs in the country. And I know we started to implement some of the CREATES suggestions, and I'm hoping to hear more about the administration's appetite for instituting more, because there was significant savings in there. But then I go back and forth because I know we've had talk about state employees being at the lowest levels since 1950, but yet the CREATES report saying that there's definitely room for us to have savings in the workforce and in the spending of the state. So I'm not quite sure where everything stands on that. And then in the revenue growth assumptions from Director Ayers, from fiscal year 2024 to 2025, we go from 250 of personal income tax up to 466. It's nearly double. And I'm not quite sure what the assumptions are behind that revenue growth assumption for personal income tax.
I think there was a couple things in there. With regard to fixed costs, I think the takeaway, and I don't want to speak for Secretary McCaw, we both have things going in the same direction. I think the timing and scope of how our individual analysts might be projecting the various buckets of fixed costs are not going to be exactly the same. On the revenue side, there's a consensus revenue process. We work together with OPM. We develop our expenditure estimates independently. I think the important takeaway is the direction that they're going, which is a positive, rather than the actual numbers. We're not going to be accurate in 2026. But I think the direction both offices are reporting are the same. With regard to the personal income, it is mainly estimates and finals that's driving the personal income tax in the out years. One of the quirks of that chart is so you're seeing solid growth in the personal income tax. That includes both estimates and finals and the withholding. That table there also includes all of the estimates and finals. So it includes the amounts over and above the volatility cap. On that same chart, page 13 of our presentation, there are negative numbers in the other revenue category. That's where that excess volatility is transferred out of the schedule. So it's both going in, coming back out.
Okay, that makes sense. And then, so I hope we hear more about whether the administration plans to implement more of the CREATES suggestions. But the second question that I have is probably more complex. If we're looking at the $1 billion deficit in 2023, which is closer than any of us, I think, really want to understand. It's December already. 1.2 billion of that is the federal money that is coming in. And Director Ayers, you mentioned the ongoing definite budgetary impact and the ongoing potential impact for the new items that were put in with the federal spending. And I guess my curiousness here is around what specifically is that federal money supporting right now? We knew that prior to getting that federal money, we were projecting a deficit out in upcoming years. Now we definitely know it's coming. And I'm wondering what specific areas we're projecting we're going to be at a loss at that money is currently covering. And I don't know how we get that, or if there's a way to look at growth in departments and areas and such to try to figure out what exactly the biggest dollars are. But I'm concerned that deficit, that money's going away, and we've kicked the can down the road a couple of years, but we need to look at what we're going to do to adjust for that coming forward. So I'd like to know what areas specifically are fueling the $1 billion shortage in the outgoing years, if we can.
I'm going to try to take that in two parts. The legislature utilized the ARPA in two separate manners. They made actual allocations for a variety of priorities. The ones I went through, say higher ed, a lot there, certain rate increases. And that's what I was trying to identify as.
Oh, no, never mind. Go ahead.
One time would be something like there was large allocation to the unemployment trust fund. Ongoing were built in, say, private provider rates. The potentially ongoing, these dollars didn't replace any normal general fund dollars. They were not part of the general fund budget. They were over and above, but entities that may have received these dollars in fiscal 23 outside the budget may have an expectation or an interest in getting a similar funding level, and those dollars are not in the budget. And we're not projecting them in the budget in the out years. We were mainly trying to identify that may be pressure on you as decision makers on the expenditure side.
Right.
On the revenue side, it's pretty straightforward. It's the $1.2 billion that was used, ARPA dollars, as revenue replacement. Under current law, under everything we know coming from the feds, that's not available in 24. So that creates your cliff, the vast majority of your cliff right there.
Okay, I'm not sure that really helps, but I appreciate the explanation. And I have other questions, so just put my hand back up after everybody's done. Is that correct, Senator Austin?
That would be accurate.
Thank you very much.
Representative Devlin, followed by Representative Mashinsky and Senator Kushner.
Thank you, Senator. And thank you, Secretary McCaw and Neil, for your presentations. Clearly, a lot of work went into those, so I appreciate that. And it was encouraging to hear the praise that you outlined that clearly was a result of the 2017 budget, where we put in those structural reforms that stopped our state from just spending any revenues that come in and actually require some fiscal discipline and paying off our debts and controlling our spending level. I wanted to just get some clarification on the revenue growth side. We heard some comments earlier that this is maybe a historic level of revenue growth for our state. But what I thought I heard you say, and Secretary McCaw, this may have been from you, both of you may have mentioned this, is that the revenue growth is really attributed to the federal grants that the state has received. In addition, the sales and use tax. And the sales and use tax, I understood, attributed to two things in terms of the growth. One was, again, federal money, the stimulus money that put more money into our economy. So there was greater sales tax revenue. And the second really being inflation. So the increased costs have resulted in increased sales and use tax. We're certainly seeing that at the gas pump. We're seeing it across the board. Is that correct? Is there something else missing? Because it seems that we'd really be in a deficit right now if it wasn't for these unprecedented one-time receipts that we're seeing.
So Representative Devlin, a lot of that is in fact true. There are a couple of areas that I would just nuance a bit. As we look at overall general fund revenue growth in fiscal year 22, we saw about 5% across all of our revenue sources. In fiscal year 23, we project 2.4%. Some of that improvement was we had a tough year in 20 and 21 because of the pandemic. Industries were closed. We did see some revenue sources that took a hit. So we are playing catch up. We also know that the amount of money the feds infused into our economy contributed to, as you said, consumer confidence, additional spending. You see that in the sales and use receipts. We also saw withholding hold on stronger than we have previously seen in prior economic downturns. The amount of unemployment income that was available, it was a broader set of individuals, including business owners, et cetera, that benefited from this. We would have thought we would have seen a heavier hit to withholding. So yes, the federal resources were a lifeline to the state of Connecticut. And I think our success in mitigating COVID, reopening industry, building consumer confidence is allowing us to see that sustained. We will have to monitor without these resources if we're able to maintain these trends. And for that reason, OPM and OFA, I think we use a good amount of conservatism to ensure that the trend will continue. The biggest challenge, I think, for us will be in fiscal 24 when we remove those temporary revenue sources that allowed us to achieve balance. And it was good for the time frame, right, to bring stability to the state at a time when we need to see industries recover. The question ultimately will be, will we see growth, economic growth, translated into tax receipts that will help to replenish the $1 billion that we temporarily use to balance our budget? And so that, that will remain to be seen. That's the caution of what 24 looks like. The positive is that as you go beyond that, at least we're starting to see that the new fixed cost growth and the new revenue growth coming in is more in alignment.
So I appreciate that. And I think it's important as well, to your point, that there are positive things like our ability to pay off our pension debts and to bring those liabilities down, which will help us longer term, but that we're also painting a realistic picture. While we might be in a positive position right now because of all of this infused money, it really isn't a reflection of the health of our overall economy, as you pointed out, with the deficits that we'll be seeing come 2024. So that's kind of tied to Rep. Nuccio's question. I just wanted to get some greater clarity around that as well. That is that gap. What I heard you say earlier in your presentation multiple times was that there'll be a need for increased revenue sources because there will be this $1 billion gap, which rather than a $1 billion potential tax increase, or maybe there'll just be organic growth, which would be wonderful. Is the gap the result of using those one-time sources essentially for operating costs? Or is it, maybe you could break it out even by buckets in that sense. Is it covering one-time operating costs, or how much is that? Is it, to the point Neil was just making, some groups have been getting extra money, and I hope the message with that extra money is that it isn't necessarily sustained. Maybe we'll be able to. But is there also new programs that have been put in place that are essentially sort of like we're seeing at a federal level, right? We'll just do it for 1 year when it maybe should be a longer term, but are there new programs that have been put in place that are requiring funding now, that those also are at risk of not having funding long term? So to simplify that, if I kind of jumbled that up a bit, looking at that deficit going forward, were those monies where we're going to see the gap? Is it due to that we were spending on operating costs, so that's going to be the gap? Is it just additional payments that others have gotten to get them through the pandemic? Or is it new programs that have been established that may require some longer term funding?
So Representative Devlin, it's a mixture, right? We knew at the time when this budget, the governor was presenting his budget, and at the time the legislature was adopting a budget, that there was uncertainty about the economy as businesses were being reopened, industries were being reopened, and whether or not and how soon we would see revenues rebound. And principally, this budget acknowledged that we needed to provide adequate time to see how Connecticut's economy responds in what we thought would be a post-COVID, but certainly it's going on a little bit longer. And so, yes, part of the structural issue is the use of one-time revenue. On a positive note, you're seeing some outperformance in revenue. The question is, will it continue to outperform, driving down that structural deficit? Thirdly, the use of ARPA for recurring costs. I think it's important to talk about the types of expenditures. We had a nursing home strike. We had concerns about the health and safety of vulnerable residents across the state that had to be addressed. This was a session that was heavily focused on equity for the workers and ensuring that they have wages they can live off of. We had a group home strike. We had those vulnerable clients that we needed to address, long-term having the security of workers to take care of them. And then we had some pressures from our private providers. So as we look at the types of things that were funded with one-time dollars, there, the nursing homes, the group homes, there were critical needs there. Yes, that does exacerbate the challenge. It does increase the amount that we're going to have to fund. And as Director Ayers noted, then there are other things that were discretionary in nature. We put a lot of investment into the communities because we felt coming out of the pandemic, they needed those investments. They don't necessarily have to be recurring. Those are the types of decisions that you will make in the next year plus to come. That could mitigate the size of that gap. Is there a problem in fiscal 24? Yes, there is. The size of it will depend on the level of economic growth, whether revenues outperform, and how much of these temporary investments we want to become permanent. So remains to be seen, but the challenge is certainly there for fiscal 24 and begins to improve beyond that.
Right. Thank you. I appreciate that. And I hate to, stick a needle in the bubble of, great news on our current fiscal state, but I do think it's really important that we're realistic and understand what some of the fundamental things are that are just covered over. So thank you. I do have another question, but I'll respect the rule and come back. Thank you.
Thank you.
Representative Mashinsky, followed by Senator Kushner.
Thank you, Madam Chair, and thanks for the presentations. I hope we'll get the slides, which are really well done, and thanks to your staffs for providing them for us. My question is on Madam Secretary's presentation. It was around page 38 or maybe the previous page, but it was about developmental services, and there was a cliff. There was a temporary improvement in services, and then there was a cliff. Does that mean that after the federal funds for these additional services disappear, that we have to pull the services, or does that mean we shift over to state funded services? Because I think these are new services families did not previously have it. Am I correct? And will they lose them?
Excellent question. Well, here's what I would flag for you. These are all new services, but the amount of recurring costs in the ARPA Home and Community-Based Services Plan ranges around, I think it's 50 million gross and 25 million net state cost. Because we put a lot of focus in modernizing our systems, assistive technology for clients to ensure that they have a better quality of care living in the community. There are incentives for providers to improve quality outcomes for the clients, as well as there is a small portion that I believe contributed to rate increases. But by and large, these investments were one-time in nature. They were put into programs so that they would be a one-time investment, an infusion of resources, and we limited the recurring costs. So that really is about $25 million net of an increase as these funds expire. Very small exposure relative to the amount of investment that we will receive.
So trying to paraphrase, so you're saying that you used the money to make the system more efficient and better serve the clients, but that won't need to persist. Is that what you're saying? For example, you might have upgraded tracking of the services or reporting, and then once that's in place, you won't have to continue that investment.
That is correct. And in some cases, there are technological investments or there are assistive technology devices and systems that are being put into their home to remind people to take their medication, to modernize that environment where it's a one-time cost, but the tools and the equipment would remain with the clients. And therefore, once you make that investment, there's no additional expense. And then there are incentives to improve quality and reporting for a time frame for providers. So we really were focused on ensuring that we didn't create a couple $100 million cliff, but still make the investments that would modernize and just overall provide a better quality of care for the clients that are in the community. The only component that would be recurring is about $25 million, and that was related to a rate increase. One of the other investments that we made that are one-time in nature is we're also in the plan that's been blessed by the legislature, including some funds for recruitment and retention bonuses, because we know the industry in terms of attracting employees and keeping them, they're really struggling. And so that was critical feedback we heard from stakeholders, that they need help with attracting folks into the industry. And so that's a part of the plan as well.
Okay, that's reassuring. Thank you for clearing that up.
Are you all set, Representative? I'm not certain.
Thank you.
Representative Mistinsky, are you
Thank
all
you.
set? Okay,
I'm all set. My signal is going in and out, but I'm all set. Thank you.
thank you very much. Senator Kushner, followed by Representative Walker.
Thank you, Madam Chair. And I do want to thank both Neil and Secretary McCaw for the presentations. My question goes to the pandemic pay. And we were very appreciative of guidance that came out of U.S. Treasury Department encouraging the use of ARPA funds for pandemic pay. And, I think I take every opportunity to thank the essential workers who are on the front line during especially the early days of the pandemic, when we all were able to stay, many of us stayed home safe and secure because of the work that was being done. And I recognize in your report that you talk about the money set aside for pandemic pay for state employees and National Guard, monies that obviously, we could end up needing more money set aside depending on the outcome of the negotiations with CBAC. But recognizing that some money has been set aside is something very valuable, and we appreciate. But I do have a question about whether or not, at what considerations have been given to setting aside remaining ARPA funds, because we know that in addition to state workers and to the employees, the people serving in the National Guard, there are, many, many private sector workers who got us through the pandemic, and they took great risk and made great sacrifices. Many of them did get sick. Unfortunately, many died. And those that are still living, we really need to make sure that we're taking care of them. As I mentioned, it's something that we think came out of, that was endorsed by the Treasury Department and was factored into the ARPA funds to begin with. And so we're anxious to know what plans you have or what thoughts you have on that issue.
And thank you so much, Senator Kushner. You are correct that the Treasury guidance with respect to premium pay does include a broader list of the types of workers that could benefit from premium pay, such as staff at nursing homes, hospitals, home care settings, public health and safety staff, childcare workers, certainly much broader. The allocation that has been included in ARPA was focused on similar types of workers that had to, come to work every day and put themselves and their families at risk. And those are the subject of negotiation with our respective bargaining units. We did also, through CARES Act, Coronavirus Relief Funds, provide premium pay to our nursing home workers. I believe we might have also done so to some private providers through CRF, where they were able to required, quite frankly, as a condition of receiving funds, to ensure that workers received some type of premium. That could have been through increased overtime rates, premium rates and overtime, or bonuses. We gave the nursing homes flexibility. As far as whether or not there's a desire to expand, we certainly have an opportunity to talk about that in the next legislative session with the remaining funds. The Treasury guidance does give the flexibility to do so.
Just to follow up on that, I appreciate that answer, and certainly there are many who are going to be pursuing that in the upcoming legislative session. It is helpful to know where the administration is on this issue, because of course that it's always best when we're on the same page. I know that isn't always possible, but I do have a concern about the monies that were provided already through the CARES Act that you mentioned, because I am concerned that the nursing home monies were not distributed necessarily in an equitable or equal fashion. And we know that we've heard stories from different nursing homes that some didn't get it at all, or the way they got it was, very different experience. And I think it's unfortunate that there was that much. And I'm not being super critical because I think we were dealing with the pandemic in such an intense way that I'm not saying that this failure would have been foreseen, but it clearly was handled differently in different nursing homes, in some cases not very well. But I wondered if there is any audit procedure that is in place to at least determine if there were any places where it was done in such a way that it was absolutely not as intended.
Senator, there were two, if I recall, two batches of relief provided to nursing homes. Early on in the pandemic, it was to recognize the significant reduction in the number of beds. And so nursing homes were feeling that in terms of lower reimbursement because they had fewer Medicaid patients. So we did provide relief to kind of get them through and ensure they had the resources to continue to serve the patients and residents. The second tranche, after we completed the mathematical report, of which many of you participated in understanding the recommendations, we took out of that some of the recommendations surrounding quality. And so we did make, as a condition of receipt of funds, we added some requirements in there on infectious disease nurses, that every nursing home had to have some level of staffing. And we built in, as a condition of receiving those funds, quality that they would need to meet and reports would need to come in. We also included temporary rate increases to get them through the period where they thought that their caseload would rebound. In both of those tranches of funds that were put out, audit requirements were included. Nursing homes had to report back to the Department of Social Services on spending. There are contracts with every nursing home that specify the allowed uses. And in that second tranche, the conditions on use related to quality. So yes, the reports will go into the Department of Social Services, and the language in the contract does say that the spending of those funds is subject to audit. That's pretty consistent throughout all of our CARES Act funds that we put out during the pandemic, that reports have to come in and that all funds will be subject to audit.
Thank you, Secretary McCaw, I apologize. I appreciate your answer. I appreciate the work that was done by the administration on so many levels to keep us safe, but I think we still have concerns about including the nursing homes and whether or not it was truly hazard pay as was intended. And so I think that's something we need to continue to look at, even retrospectively, at those funds that were already expended. So I appreciate your answers, and I'm sure we'll be talking about this in the coming session. Thank you, Madam Chair.
Thank you, Senator. We're happy to look into this further with you to ensure that the funds were used appropriately.
Thank you, Madam Chair.
Thank you very much. Representative Porter, your hand is up for the first time. Would you like to go now?
Yes, thank you, Madam Chair, and thank you, Secretary McCall and Neil, for the presentation. I just want to piggyback off of that because, as labor chairs, hazard pay is like the thorn in our flesh. I was actually at a press conference yesterday with the Connecticut transit workers in Hamden, and you did mention some categories that are included. So just for the record, and I heard a earful, they're irate. They need and they want hazard pay yesterday. Are they going to be included in what you stated for the federal guidelines? Because I'm not sure, so that's why I'm asking.
Thank you, Representative Porter. Always great to see you. In terms of what is allowable, Treasury guidance does allow for hazard pay to be provided to truck drivers, transit staff, warehouse workers, so they are eligible. The allocation that the legislature approved was intended for state workers. So if we're talking outside of state workers, then we would need to have those discussions in the next legislative session, and we'd have to build an allocation into the amended budget.
Yes, and I think that's important that we do that, Secretary McCall. because, and I'm gonna piggyback and I'm gonna reiterate and I'm gonna belabor the issue around the fact that these nursing homes, and I have a sister working in one, there are workers who did not receive that hazard pay. And their question is to us as state lawmakers, why aren't you guys following the money? Why aren't you making sure that what it's been allocated for, that is the purpose it's being used for? So there needs to be some checks and balances that we can account for through transparency, because rate increases it doesn't mean it makes it to the workers.
Understand.
So we need to be able to report on that and make sure that we're dotting our I's and crossing our T's, because the people that got hit the hardest were the essential workers. They didn't have the luxury of sitting at home and staying safe. And we know that we lost many of them, and they lost many of their family members through contract and what they brought home with COVID. So we're going to keep harping on this, because every time I go out somewhere, this is what I'm faced with. These are the questions that are being put to me. And these workers are very disgruntled. So I want to make that clear. And I need for, the administration to understand that, so that we can address this in a way that's going to benefit us in 2022.
Representative Porter, we will do the follow-up. I do see Undersecretary Claudio Gualtieri. So we'll be reaching out to the Department of Social Services so that they can look at the reports of where premium pay was provided and be ready to have that discussion.
Thank you. I appreciate that. And I hope we can do something like the Treasury did with that $13 an hour for all. I think that would be a great way to boost the economy and provide these workers with the stability they need and deserve.
All set, Representative Porter?
Yes, Madam Chair. Thank you very much. And thank you all again.
Thank you. Representative Walker?
Thank you, Madam Chair. I just want to thank both Neil and Secretary McCaw for your presentation. Secretary McCaw, you mentioned the fact that the infrastructure grant that we got from the feds has a matching amount, and I did not write down how much that matching amount is. And the other part of that is the total amount is one number, and then part of that total amount will be our matching. Is that correct?
Yes, so there's $6 billion coming to the state of Connecticut. A portion of that is the baseline funds that we've historically received. And the baseline dollars, we have the match, it's budgeted. So for the additional funds we're receiving, we expect that DOT will need a match of $80 million for their formula grants. And then for the competitive grants, that remains to be determined. Each grant, of course, based on our associates in Washington, the match will differ. So we will have to go program by program. So there's some amount that will be needed for competitive. And then there's DEEP and DPH, and there's also a broadband component. And we're looking at matches currently estimated north of $25 million.
In addition to the 80 million that
yes, Representative Walker. Right. That is correct. These numbers will have to be, sharpened, if you will, once we get the specific grants distributed and formalized from Washington, and then we'll be able to know grant by grant which ones we're going after, which ones are formula, and what those amounts are. But those are the current estimates we have in-house.
Thank you, ma'am. You did mention that there was money that we had to match in the previous dollars that we got. How much did we, what did we have to match, and how much was it?
I'll have to get the exact number to you, but I believe we currently, we have about $700 to $800 million of assumed special transportation obligation bond issuance in the transportation fund. Some amount of that is the match towards the federal funds. And then there's some component that just supports 100% state funded projects. We will do in our follow-up, we'll send you the specific amount.
Okay, I think it'd be good if we could talk about it, because that we've got to know that now before we get into the next session. So
absolutely.
Thank you both for your presentations. It was great.
Thank you.
Madam Secretary, for clarification, is that 80 million and 25 million respectively each year, or is that overall?
Each year, Senator.
And is that intended to be bonded by the administration?
We are considering that some portion of that will be bonded, yes.
A portion thereof?
Yes.
So can you get that breakdown on what you expect to put in the budget? and
We
what
are-
that portion thereof.
We're still finalizing that, Senator. We'll have that for you when we submit the governor's recommended adjustments in February. We expect by then to have more clarity out of Washington as well.
We're going to thank you. And Representative Walker started our second round of asking questions twice. And I have a question relative to clarity. Has there been progress made in hiring state police?
We have, I apologize, I don't have the status of the current class or our active count, but we will certainly follow up and provide that to you.
And on page 31 of your presentation, and so everybody knows, the presentations are going out to everybody. You might already have them in your email of both slide decks of OFA and OPM. On page 31, it shows that 74.3% of CERS liability is retired or deferred liability. How much do you anticipate of this to increase over the next year?
Can you repeat the question, the page, Senator?
Page 31. And it shows that 74.3% of CERS liability is retired or deferred. How much do you anticipate this to increase in the next year?
We'll have to go back and look at the actuarial assumptions and the valuation. We do expect an updated CERS valuation, and we'll get that information for you in our backup.
So CERS valuations are done each and every year. TERS valuations are not done every year. I've put in a request that TERS do a valuation this year. Is OPM willing to put in the same request to TERS so that we have an idea on what that $900 million influx of payment plus the increase in the amount of return on investment that we have had relative to the market, so we can see where we stand.
Senator, I believe there's a statute that governs the timing of the TERS evaluations. We certainly can inquire of the TRB. They would, however, need to agree and have the board adopt those valuations in order to formalize that into an updated ADEC. So I've already spoken with our team. We'll begin those discussions.
Thank you very much. Appreciate that. Up next is Representative Devlin, followed by Representative Cheeseman, followed by Representative Nuccio.
Thank you for that. Just a follow-up question, Secretary McCaw, this is for you. It actually follows on a conversation and question with Rep. Meskers and the additional positions in the DOT. You talked about a federal reimbursement. If I understood you correctly, I think you said it results in cost to the state of just 20%. And if that's accurate, my question is, for how long? Is that for the lifetime employment of those individuals within the state of Connecticut, or is it just for as long as the federal funds exist? Can you provide some more clarity around that?
Yeah, thank you very much, Representative Devlin. It is for the duration that the federal funds exist. And so obviously over the next 5+ years, we're going to see a spike in infrastructure funds. We will need to bolster staffing with engineers and architects and inspectors, et cetera. And so as those projects close, then to the extent that the DOT needs to reduce, would be able to reduce staff, they certainly would have the flexibility to do so. Or as they see attrition and vacancies materialize, they could shift those federally funded workers over to the Special Transportation Fund. So yes, the funding source is time limited, but the need is also tied to the increased amount of projects that will be flowing throughout the state of Connecticut.
So the attrition rate would also depend on if those people leaving had the same skill set as those that stayed, right? So great that we would get funding for 5 years, but then the taxpayers fund the ongoing kind of rate for those employees. Is it an option for reimbursement for contract workers versus hiring full-time staff? Does that have to be full employees? Because in any commercial enterprise, right, there are short-term bursts and you have to weigh. Does it make sense to hire staff that are going to be long-term? Because you don't want to hire someone for a 5-year period unless that's part of your agreement. And certainly the agreements that we have had in place in the state of Connecticut have prevented anybody from being let go prematurely at all. So is that an option?
It is. The department has flexibility between their use of state personnel and contractual support. to meet the needs of the infrastructure or any of their projects.
Great. Thank you for that clarification. I appreciate it.
You're welcome.
Thank you very much, Representative Devlin. And I just wanted to make a point of clarification on some of the things that you have said. First, the number of transportation workers that we have put in the budget still does not, we have never been able to hire enough people to do the work regularly in the Department of Transportation. We have over 300 positions that have been open each year as we have struggled to find the capable people with the correct classifications through that mechanism. Relative to your comment to the number of people, we are now down to below the 1950s level of state employment. That's been for the last 4 years. That's been reported at this FAR report. So our number of employees has has been down quite a bit. And relative to our changes in the 2017, I think you're referencing the 2017 CBAC agreement. We have fully a third of the state employees that today, and I would never suggest this, that could be let go today. Because there are newer people, and that only applied to people before 2017. We had significant changes in our pension systems in 2011 all the way through 2017 relative to return on investment, how we did our pensions in our state employments, and a number of other things. So I just wanted to point that out because sometimes the information gets viewed in these public events where they don't understand the history of things. And I want to thank you for your work on this issue, but we have made significant changes in our state employee pension system down to 1950s. We pay $100 million less right now in the number of both our pensions and our health care.
I appreciate that. I appreciate that very, very much. And I also have talked with the commissioner and understand he does have a need for certain positions to be filled. So I'm not suggesting that no positions should be filled. My question is it an all or nothing proposition? And in addition, I think we both agree, right? If you're hiring somebody, unless it's part of your agreement, it's for a 5-year window, then you are expecting a long-term relationship of employee-employer, whether it's private sector or public sector. So I appreciate your comments very much.
1,000 people in the next 2 months or 3 months. Thank you very much. Representative Cheeseman, followed by Representative.
If Senator Austin, it's Representative Wood. I've been on for 2 hours waiting.
Oh, you just showed up, Representative. I can't hear you. I can't, Representative Wood. Does anybody have Representative Wood's number?
That's not very good. And I know, I didn't realize each time I probably have logged on a dozen times.
Did somebody text, Sue, can you silence Representative Wood?
I'm texting her now, Senator Austin.
Thank you very much, Representative. Sue Keene? No. Sue Keene, can you?
Can you?
No.
I can hear.
No, we can't hear you.
I can hear you.
No.
All right.
Representative Cheeseman, followed by Representative Nuccio, and we'll try to work on Representative Woods.
Actually, Senator Austin, I just wanted to let you know, I just texted her and told her she was breaking up and asked if she wanted to send her questions and I can ask them for her.
That would be great.
As long as they're not my 2 questions.
Representative Cheeseman.
Thank you very much. Looking at, I believe Senator Austin referenced that slide saying, the percentage going to the employers we're paying toward actuarially determined contributions. Given what we're paying into the system in payments to reduce the amount, is there any point at which employers will see a reduced contribution? Because we constantly hear, particularly from UConn Health and UConn, how those costs affect their bottom line. I think UConn Health has said absent those costs, they're actually in the black. The former President Katsouleas testified that those costs are looked at when they're looking at grants for professors. And maybe this is a question for Director Ayers as well. Does this ever play in, as we make those increased contributions, into reducing the amount that our employers on the state level, particularly UConn and UConn Health, will have to make to keep the system whole?
Director Ayers, I'll jump in here and then pass it to you.
Absolutely.
When we look at Representative Cheeseman, when you look at SERS, we are reaching level dollar as we approach fiscal year 2024, right? We've been ramping up over many years to level dollar amortization, so that is going to slow. From that point on, the year-over-year amount of the ADEC will slow. The rate of growth will slow. Obviously, that is all the disclaimer I'll put out there is it all depends on how we're doing with our market gains and losses. Are we meeting our investment rate of return? So with that in mind, let's assume that our ADEC assumptions are correct. Given that the rate of growth in that ADEC is slowing, if we are able to continue to make these significant payments towards the pension fund, then you could see a year when the ADEC is flat or there's a slight savings. Then that would get parsed out to the various employers, but I expect that it would be very small. I think what's most important is that we're getting to what will be level dollar amortization, and the ADEC will be flatter than we've seen in the past, depending on what happens with, the number of retirements and wage increases and market investments and returns. So it's possible, but it remains to be seen. What I think will be most helpful to those employers is that the spikes we were previously seeing, because we were playing catch up, if you will, on the unfunded liability, hopefully will be a little softer than what we've experienced most recently.
I don't believe I have anything to add to that.
Okay, thank you. And just quickly, and this may piggyback off Representative Mesker's questions with regard to dynamic scoring. I know certainly looking at all of the EDA opportunities, both in terms of competitive grants and outright dollars the state is seeing with things like the Build Back Better Regional Challenge, the Good Job Challenge. So in effect, you don't factor in any potential growth in terms of increased employment, anything like that, into your projections. You're just operating in the universe as we know it, correct?
That is not true. I mean, both OFA and OPM, we use IHS for economic metrics, and Neil, I don't know if you're using Moody's, but in any event, as we look at personal income tax withholding and sales and use tax, we're looking at measures like gross state product. We're looking at their projections on wages and salaries. We're looking at we're looking at the current trend. What is our historical norm? And then what are economic experts projecting in the years to come? So I'd say our projections are dynamic. They do factor in the economic metrics forecast, and we evaluate them at every consensus revenue time point, and we tweak them accordingly if we feel that there are changes warranted. Now, that being said, to the extent that IHS or Moody's are looking at the significant investments coming out of Washington and factoring that into their assumptions, then I'd say that dynamic forecasting is reflected in the work we're doing. We'd have to go back and evaluate whether or not they're building that into their assumptions.
So if they build it into their assumptions, it would factor into your calculations going forward.
Yes, and Director Ayers, did you want to add anything?
No, I agree as well. I mean, we're not economists at OFA. We don't individually do a dynamic scoring, but the data that we're relying on may take these factors into account.
Thank you.
We rely on Moody's. That's our contractor.
Thank you for those answers. Thank you, Senator Austin.
Thank you very much, Representative Cheeseman. Representative Nuccio, were you able to reach Representative Wood? And please apologize, I just saw her hand come up just this last time, so she was not showing up earlier at all. So if you want to ask her questions and then your two.
Thank you very much. Okay, her first question is, Secretary McCaw, you mentioned organic revenue growth in the context of job recovery. Which economic sectors are outperforming expectations?
When I make reference to organic revenue growth, I was speaking to that structural gap that we're going to have to close and the extent to which naturally our revenue sources will be higher than what we're forecasting. And that would obviously help to close the gap absent us having to make policy changes, whether it's tax policy or spending policy to make that happen. With respect to industries that are outperforming, there was a slide in the deck that showed overall where we are relative to pre-pandemic levels for job recovery. And in the top 3 sectors, they are still not yet at their pre-employment levels. So, you know, the retail industry, the hospitality industry, the education industry, you know, the point of that slide was that there's still work to be done to get back to the pre-pandemic levels. I'd have to work with the team after the call to see if there's any data that suggests whether or not we are outperforming relative to any assumptions we might have had on job recovery. I don't know that we had specific industry by industry projections, but there might be some data out there.
Okay. And her second question is, Secretary McCraw, I'd like clarification on the 2 stats you gave. This kind of rolls into the last one. 72% post-pandemic job recovery, and then 94% job recovery compared to bordering states. Asking this question in the context of Connecticut as of February 2020, being the only state in the country not to regain the jobs lost from the 2008 recession. And she wants to thank both Director Ayers and Secretary McCaw.
Thank you so much. The 72.8% stat was reflective of from February 2020 to April 2020, we lost precisely 292,400 jobs. And as of October 2021, we have regained 212,900. So that's 73% of the jobs we lost. The slide also had a statistic that referenced a 93%, and that is based on 1.7 million jobs in February of 2020 relative to the total number of jobs in October 2021, which is 1.6 million. So it's 1.616 million as compared to 1.696 million total jobs. So that means 95% of our total jobs have been reclaimed, if you will, versus how many did we lose? 292,000, and how many of that 290,000 we regained? 2 different ways to look at the employment regains and rebounds for the state.
So the 293 is the 72%. We've regained 72% that we lost.
That's correct.
The 293, and then the 93% is the total number of jobs that we had.
That is correct. It's overall employment recovery. And on slide 32, we provided you with a comparison of how we were doing relative to the other states. So we're at 95.3% compared to our April 2020 employment. And you were able to see that we're outperforming Massachusetts, New Jersey, New York, Rhode Island. And then when we look at the nation is at 97.2%. So 97% of the total jobs compared to April 2020 across the nation have been regained or recovered.
I'm going to wait to see if she has follow-ups because I'm still confused. So I don't know if she still is too.
Very good.
In the meantime of waiting to see if she follows up, Senator Austin, can I go ahead and ask
Please do.
And Terry, if you're listening, if you have any other questions, let me know as follow-up. So my next 2 questions, one is around the entitlements and Medicaid. I think this was possibly Director Ayers who had said this. We talked about increased enrollment, increased reimbursement, and increase in provider payments. What I'm curious about is what portion is the increased reimbursement in comparison to the other increases. I think somebody else may have asked if we're going to continue those extra payments for provider payments and such. I'd like to understand, and I know you may not have this right now, maybe a separate meeting, but to really kind of look at the Medicaid numbers is what is the total increase in enrollment? What's driving that? Which piece of it is increase in provider payment? What will that look like to 1, 2, 3, 4, and 5 years out? And then when we do not get this increased reimbursement from the federal government, what is the net budgetary impact that we're going to have to plan for in the out years?
I don't have the details on my fingertips. Happy to set up a meeting with our Medicaid analysts. They can walk you through it. They know the stuff inside now. With regard to the increased Medicaid match, that's only impacting the current fiscal year. It wasn't assumed in the second year of the biennium, so you don't have anything to make up there.
So the match is only in this current year?
Yes, and it was originally assumed when we passed the budget to be effective through the end of this current calendar year. The federal government has extended it through the first quarter of next year. So that's where we're generating some savings there. But we're not assuming that going forward. So there's nothing to make up.
So it's extended to next year?
I think through March.
Through March. Okay, are they shown differently? Or do we show the Medicaid expenses in one area and the Medicaid revenues in another? So
that's a complicated question.
I like those.
The Medicaid account in DSS is net funded. So it only reflects the state's portion of the Medicaid expenditures. Medicaid reimburses expenditures in other areas of the budget, a lot in Department of Developmental Services, Mental Health and Addiction Services. The expenditures are gross appropriated, the full costs, and then we make a claim on them after, and that federal revenue is reflected in the revenue table. So the federal impact there is reflected in the revenue table for non-DSS agencies, whereas DSS is reflected because we're only showing the state's portion of the expenditure.
Okay, so I'd definitely like to do a meeting on that, because I guess that's where my question here is, if that's the case, then when the additional revenues go away, the expense number should be solid going forward, with the assumption, if what I'm hearing correctly is the increase in provider payment and the increase in enrollment are planned in and are going to extend past. Like that's built in and gonna be there, correct?
Presumably, it would be best to talk to our Medicaid analysts on that.
Okay. Let's set that up because I have more questions. Thank you very much. And then the next question that I have is, I believe this was Secretary McCaw, I'm not 100% sure, but we talked about the mental health stuff, and there is a huge amount of investment in children's mental health issues right now. I, like you, have been saying, we need to focus on anything that's happening to a child right now is also happening to an adult, and especially our elderly community. They've had a lot of seclusion, and their mental health issues have really kind of topped out at numbers I don't think we've ever seen, especially from that generation who is extremely resilient. So the need to invest in adults, the need to invest in urgent care, crisis care, I'd like to understand what we mean by that, and more mobile units. My question to you is, do we have a summary somewhere, or can we put one together of all of the funds that we've gotten from the federal government thus far that we have now since invested in children's mental health, so we can get a good idea of what services we've actually already put in place? I know the mobile crisis units, that's 24 hours, 7 days a week now. We passed that legislation, and that is one area that's going to be impacted by that. But I'd like to really understand the spend that we've currently made for children's mental health, and then get a better understanding of these services that you mentioned. Which ones would be going to children? Which ones are we looking at for adults? And then so we can have a plan. We're currently meeting to talk about a lot of the mental health issues and allocation, and I'm meeting with a bunch of people on that to try to come up with effective ways to use the money here. So having that breakdown would be like gold mine.
Representative Anuncio, yes, we will provide you with a summary of what's currently funded for children's behavioral health, and then we will send over to you the governor's proposal last May on adult behavioral health, so that is fresh in your mind of what the administration was interested in. We really wanted to see an expansion of the mobile crisis units. We also felt that having the urgent care centers, giving folks another place to go other than the emergency department was critically important. And then to have services to then connect them to a provider. So we forward that through Ms. Keene and ensure that all members have a copy of the governor's requested plan.
I appreciate that. And if we can just make sure it includes all agencies too. So if what I just heard correct, you're saying to utilize existing urgent care facilities and offer crisis care in there. So that would be like a ramping up of professionals in an urgent care setting that could handle psychiatric issues and then hook people up directly with outpatient services.
We at the point of the governor's proposal, we had not gotten to the level of discussion as to whether it be existing urgent care centers. We anticipated the need to put out an RFP in order to see what kind of appetite there be. Existing urgent care centers could apply, or we might have organizations that want to stand up separate or standalone mental health focused urgent care centers. More importantly, the Department of Mental Health and Addiction Services, DCF, as we begin to talk about the areas where there's a gap, we recognize that accessing services is still a challenge for folks. Certain times of day, the only option is to send someone to the emergency department, at which they might not really be able to get much service. As a quick evaluation, they're sent home. So there really is a gap in the service delivery system. And then other times we hear from DMIS that there is capacity, and we actually need workers that will link these individuals to where there's capacity in the system. So those are some of the maybe 2 or 3 of the components of the plan. We'll send you the detailed program over to you for your review.
Thank you very much. And then Senator Austin, you could just humor a request. I would wondering if there's a way to get a separate session on the STF. I feel like there's a lot of moving pieces here between the $6 billion that the state is going to be providing, plus an additional $1 billion in competitive grants, plus, as you mentioned, the need to be able to fund the 80 million and the 25 million, or the possible 50 and 100 million. There's a lot of dollar amounts floating around. I'd like to really understand the dollars that we're going to get from the federal government, what the state is going to be expected to produce, and that, if I read all the charts correctly, it doesn't seem like that is included in the STF current projections. So I'd like to kind of get an idea of all the money that's coming in, what's going to be expected of the state, and what we kind of hope to get from that. So if the 2 committees can see a way to do it, I think having a meeting on the STF would be very, very beneficial.
Thank you. I'm sure that we will be meeting about the STF. I know the Transportation Committee, in conjunction with the Transportation Subcommittee and the Appropriations chairs, will be meeting on some of these issues relative to STF. And I'm assuming that many people in the legislature would like to have a say over the funds relative to what we did with the other ARPA dollars. And so I'm certain that we'll have that discussion also to see what the appetite is for the people to weigh in on that.
Thank you very much.
Any other questions, Representative Nuccio?
I am good for now, and I haven't heard back from Representative Wood, so I'm gonna assume, unless she can't get through, I will raise my hand if I get something from her.
Thank you very much. Representative Meskers, you're the last one up, and then we will start wrapping this up.
Okay, thank you very much, Chair. I wanted to repeat and clarify comments. So I appreciate everyone acknowledging my comments and questions about the federal funding. So when I looked at how we grilled both Secretary Melissa and Neil about our revenue projections and our tax collection for the coming years, the $6 billion needs projects specific to be allowed from the federal government. The $1 billion needs specific grant writing ability to get done. That's $7 billion of variable revenue to the state or to the private sector, which conservatively should generate 5% to 8% sales tax, income tax. We're talking $100 to $200 million, which could foreshadow the gap we're looking at in 24 and 25. So whether or not those are employees of the state or not at DOT, I think the most important hires we could make would be the hires that are guaranteeing us the $6 billion of expenditures from the federal government and the billion of discretionary. There is nothing more important that OPM and the DOT can do for me as a state than to make sure we suck as much money as is available from the federal government. So I just want to tell you that I probably won't be laser focused on you on this, but I will be laser focused on the DOT, that we have the appropriate people to do this. Those particular jobs, I think I'm indifferent as to whether they're state employees or not, other than I want the best and the brightest to do that. Our federal delegation works tirelessly to provide opportunities to our state. This is an opportunity to change the narrative that Connecticut is the major taxpayer into the federal government and doesn't necessarily get its fair share. We're talking about $1 billion potentially of incremental revenue to the state from the feds. So I just want to reiterate my super laser focus on that and anything you can do to help us there.
Thank you, Representative. And I want to assure you that the governor is also laser focused on infrastructure and ensuring that the agencies have the resources to go after these dollars. Please be reassured that this is top of mind for Governor Lamont, and our agencies are pushing the DOT and the DEEP to ensure that they're starting their recruitment process, so they have the staff in place, whether it's staff or some blend of contractors, to move these projects forward for the state of Connecticut. So thank you very much.
Thank you for everything you've done for us. I appreciate it.
We just had Senator McCrory put his hand up. Senator McCrory, we're wrapping up right now. You have questions, sir?
Very quick question. Thank you, Secretary. And I don't know if it lays in this conversation or somewhere else. When DOT and DEEP starts to hire contractors and hire people, who's going to be responsible or monitoring the fact that this is conversation about with diversity, equity, and inclusion is a conversation that's being held throughout communities across the state of Connecticut? How are those organizations, people who have been marginalized, who have not got an opportunity to contract with DOT or DEEP, how are they going to be able to play in this arena once these resources come to the state of Connecticut? Who's going to monitor whether they're doing what they're supposed to do in regards to diversity, equity, and inclusion for these dollars that's coming to the state of Connecticut? That's my question.
Senator, good to hear from you, and you'd be remiss if I didn't get that question from you. So thank you for joining. I'm not sure if you participated in the recent hearing that the Appropriations Committee had pertaining to hiring and the dashboard that has been created by DAS. Part of the critical reason for the dashboard was to create accountability. One, to be able to track progress on hires, and to be able to track progress relative to what percentage of those hires meet certain diversity requirements. I will say the following, if you've followed any of the work that we've done in the Council on Women and Girls, particularly the Leadership Subcommittee, we spend a lot of time looking at our affirmative action policies. And sometimes for state agencies and certain jobs, the affirmative action goal may not be a diverse candidate. So that's something that our agencies are cognizant of. We also remain committed to attracting a diverse employee population and those that meet the requirements of the job. But I flag that for you because sometimes there can be a natural tension between an affirmative action goal and a diversity goal. That being said, the administration continues to have discussions about the importance of having a diverse workforce. Those are discussions we have with all of our commissioners and that we emphasize with each of the 8 human resources leads. I will flag that this is an area of concern for you as we begin to operationalize how to roll out the infrastructure dollars and how to bring the staff on, that we ensure that there's equitable access to all sectors and to people of all backgrounds. And I know that you will not be shy and you'll be reaching out to ensure that's happening as well.
I would say that it's not necessarily specifically a concern for me. I think it should be a concern for the entire state of Connecticut. It's not just my voice, it's the voice of many people in the state of Connecticut when it comes to opportunity, diversity, and inclusion. You mentioned something about a dashboard. Can you explain to me what this dashboard is? Who's at these dashboards? When do they meet? Is there a possibility for other people to be a part of that conversation? Because if you're not in the table having these conversations about diversity, equity, inclusion, in my experience in the state of Connecticut, it doesn't happen. So can you speak to me a little bit about a dashboard? Clearly, I wasn't at the last meeting when this conversation came up.
Senator, the dashboard is just an IT tool to be able to track by department and by types of jobs, how many hires are occurring, what the gender makeup is, what the racial makeup of the hires are, so that we can monitor. I mean, what if you can't see the data and the progress you're making, you can't measure if you're moving closer to the goal. So one of the recommendations that was supported by OPM and DAS was to create this dashboard agency by agency. DAS presented it, I believe, maybe last week or the week before. But what's most important, I agree that the concern is not one shared by you, but it's across the state of Connecticut. And just like we've been doing with every other policy area, we've been building in an equity lens. We need to build in an equity lens as we think about how to roll out these dollars, what communities they go into, who's getting the jobs. And I appreciate you raising that. I'll certainly be raising that with the commissioners that are going to be at the forefront.
Well, I thank you for doing it. I will absolutely be doing it, because I'm gonna tell you right now, I'm not comfortable with the history of some of these agencies and their responsibility when it comes to diversity, equity, inclusion, when many of these terms were used during 2020. And like I said back then, and I'm saying now, being held accountable is something that I'm going to do. So I'm gonna tell you right now, from the start, I'm not comfortable with some of these agencies doing what they should have been doing in the past. If they don't have a good track record in the past, I don't see how they're going to have a good one in the future. So I would definitely be in every conversation. I'm going to try to include myself, because if you're not bringing it up, it is not bringing it up, it doesn't get handled. That's my experience. So thank you very much. And I will definitely be in communication with all your dashboard individuals and your commissioners around diversity, equity, and inclusion for all people that are living in this state of Connecticut, with billions of dollars is coming here. We have to change the way we do business. And unfortunately, I haven't seen much change. Thank you.
Thank you, Senator. And I want to add one more, that you be a part of our part of the solution from a workforce development perspective. We have $70 to $90 million that the state will be rolling out in workforce development. And it's also important for us in those pipeline programs to ensure that there's a diverse demographic that are participating, that are getting skilled, that have the certifications and are ready for the job. So we look forward to partnering with you on that as well. And I'm sure that Kelly Valeris from OWS would welcome your participation.
You will be getting it. Thank you.
You're welcome.
Thank you, Senator. So we're going to start wrapping this up. Representative Scanlon, do you have any wrap-up comments?
Just to thank Director Ayers and Secretary McCaw for their insightful presentations and their stamina today while answering some tough questions. I know that I speak for Senator Fanfara and the members of the Finance, Revenue, and Bonding Committee that when I say that we look forward to continuing this discussion in a later date and keeping on track of this. But just want to thank you for your time today, and thank you to you, Senator Austin, for chairing this hearing.
Thank you very much. Representative Cheeseman.
Ditto. Thank you, Senator Austin.
Thank you, Senator Fanfara.
I do not. Thank you, Senator Austin, very much for your leadership today.
Thank you very much, sir. Representative Walker.
Thank you, Neil and Secretary McCall for, I should say, executive. What's your title, Neil?
Neil works.
Okay. I want to thank you guys for everything and ask that whatever information you send it to Sue, so we can make sure that everybody gets all information and everybody is abreast of what's going on. And thank you all for participating. This was a very good discussion. Thank you. Thank you, Senator.
Thank you very much. Executive Director, Mr. Ayers, do you have any final comments?
The only thing I'd say is everything in the slideshow today was taken directly from our report, which you should have received on the 19th and the 20th. There's a lot more additional details that you might find helpful.
Thank you very much, Neil, and everybody should have a copy of both the FAR report, the Office of Policy Management's analysis, and the 2 slide decks. Madam Secretary, any final comments?
Madam Chair, no, just thank you for the ability to present here today, and thank you for the engaging discussion. We look forward to our continued work as we approach session. As always, the Office of Policy Management is here to support and provide information that is helpful to all of you. Thank you so much.
Thank you very much for both of you for presenting all that we had to do. Madam Administrator, can you let us know what updates we might have on future meetings with the Appropriations Committee?
The Appropriations Committee hopes to hold its forum, the aforementioned forum on children's behavioral health on December 13th. Still working on confirmation of the time, but that's our hope.
And we also have a couple of SPAs coming up, state plan amendments that we will be working on. I think there's 3 that were published in the Law Journal in the last couple of weeks, 1 today and 1 last week and 1 the week before. So people just be aware of the fact that we do have state plan amendments coming up, the Children's Behavioral Health Forum, and then we will be having an adult behavioral health forum. That probably will be in the first week or so in January. So thanks, everybody. Keep your schedules free. We've got a lot of work going on, and I look forward to seeing you all in person soon. Get ready for those holidays. Thank you.